think the bull cases have gone away.
There's quite a lot of momentum still to be had, particularly in the first half of next year.
What tends to happen, though, in January is all the sort of market moves that we have in December get completely unwound.
As the market broadens out, what that means is that the former winners are going to start to decline a bit.
I'm not really sure if markets really know what to expect. I think that creates some volatility.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into 2025, following the best back-to-back yearly gains since the late 1990s. Equity futures on the S&P 500 bouncing back from 4 days of losses. On the S&P, we're higher by 0.6%. On the Nasdaq 100, we're up by 0.8%. Your forecasts for 2025 shaping up as follows. They look a little something like this. The average, about 6,600. The highest, Oppenheimer's John Stolfus at 7,100. The low, Lisa, the low, and Happy New Year, comes from Cantor's Eric Johnston at 6,000.
Yeah, well, again, this isn't exactly a terrible year of losses after the two consecutive biggest gains in the S&P 500 going back to the late 1990s. A real question here about where the leadership will come from, because what we have seen is a narrowing in breadth. This past year was supposed to be the year when big tech lost its dominance to the rest of the equal weight. That has not happened. So that's the question. Can big tech continue to power the rally that we've seen so far?
Post-election, we all heard the calls. We were going to see increased participation, negative breadth. We were going to see small caps pick up the mantle. We saw that for about a month through November. Then in December, they had a terrible month. Let's see what January brings. As for January, this is the lineup. So January 10th, we get payrolls. You've got to wait another week for that. That's next Friday. The week after that, you get CPI on January 15th. And then we've got the inauguration on January 20th before we get the Federal Reserve on January 29th. So, Lisa, the year doesn't really begin until we get that data on the 10th and 15th. And then for many people, the year still won't begin until Inauguration Day in America.
So essentially, we can get all of the revisions to those forecasts starting in March. As you always say, start writing your year-ahead forecast in March at a time when there are a lot of questions about the tale of two halves. And that's what we hear in pretty much every outlook that we hear for equities, for bonds. The fact that the first half of the year will be this question of what the Trump administration can do. The back half will be what the ramifications are for some of those plans as they go into effect. That's the reason why it seems like there's more confidence baked in about the first half than the second half about dollar dominance, about the idea of potentially some of these ongoing gains.
Jim Reed of Deutsche Bank attempting to make it easy. He writes the following this morning. For the last 4 years, the first trading day has been a contrarian indicator, with the S&P 500 ending the year in the opposite direction it moved on the first day.
Basically, ignore it all, go home, stay on vacation. Look, I think that there's a really big existential question right now for markets. You've had this massive rise in 10-year yields that has really pressured a lot of that equal weight, that has really created this existential question. Is it that rates are too expensive or too cheap, rather, or is it that stocks are too expensive? And that ultimately is going to be the question, and it's not going to be established today on January 2nd when everybody comes back to work, before we get the payrolls, before we get CPI, and before we get a real sense of what a Donald Trump administration will look like.
70 basis point move on the 10-year yield through last year. 70 basis points. The 10-year this morning, 453. HSBC's Max Kettner says we're in the danger zone. And that means it's going to be a choppy ride for the first month of 2025. Got to get used to saying 2025. Welcome to 2025 and Happy New Year to you all. Equity futures on the S&P to kick off a brand new year, elevated by 0.6%. Coming up this hour, we'll catch up with Geoff Yu of BNY, looking for a continuation of trends in 2025. James Lucier of Capital Alpha Partners ahead of a House Speaker vote. And we'll speak to Dan Ives of Wedbush on his top 10 tech winners for this year. We begin this hour with stocks rising to kick off 25. The S&P 500 closing out its best two-year run since 1998, despite ending 24 with 4 days of losses. Geoff Yu of BNY writing the setup for markets into this year is good for a continuation of trends. There's uncertainty ahead, with all the plans and forecasts for 2025 expected to change on January 20th when President-elect Trump starts his term. Geoff joins us now for more. Geoff, welcome to the programme, sir, and Happy New Year. What have you told clients about how to approach the beginning of this year, when for many the year does not begin until the inauguration on the 20th?
Well, certainly we would agree with the dates in question. But when we go back to the points about continuation of trends, on the US side, we've we've said last, if it ain't broke, don't fix it. US exceptionalism is something that we do believe in, and I think it will manifest itself through growth, through rate differentials. That's being priced in already via the dollar. But I would say for APAC and also for Europe, I think where there may be a slight trend change, it's not suddenly everything getting better, but maybe less bad. And when you have that less bad narrative coming in, some of the other trends which have been maintained, I'm still targeting euro-dollar towards parity, for example, but how much further can we actually go through that? Are people talking about further downside in Chinese equities, for example, when there's such a strength of feeling domestically surrounding the need for growth to stabilize or even improve, as the leadership has highlighted? So that less bad narrative elsewhere outside of the US, I think that could provide for some surprises up ahead.
Saw that downside in Chinese stocks earlier on today, Geoff. The CSI 300 down by close to 3%. The Hang Seng in Hong Kong finishing the session lower by more than 2%. It's actually the fragility stateside I wanted to build on. 4 days of losses in a holiday period. I get all of that. But we saw that weakness emerge through much of December. The negative breadth that Lisa was talking about. The underperformance that we saw in the small caps, the Russell, after a monster gain for the month of November. How much weight are you putting on some of the weakness that we saw to finish 24 into 25?
Well, I would back you up by saying if I look at our flow indicators, especially on the volume side and in FX in particular, it actually has dropped off quite a bit in Q4. Not really something that we want to see. But look at the event risk in Q4. We had the US election, we had the December Fed, but this didn't really force through a rise in activity. So it just feels like people are happy with their positioning. It's not that they're negative. It's just how much follow through, how much incremental positioning can you allocate to what you have already done already? I think that's something we have to be concerned about in terms of what's driving markets. Do people want to be more overweight their current positions compared to where they were? I think that's where the nervousness is coming through, and maybe relative value trades for the time being, especially for Q1, that's where people will deploy risk.
I can buy that, Geoff, this idea of exhaustion, the idea that people have had a really good year and they don't know how much more risk they want to put on. At the same time, that weakness that we saw at the end of the year really came with a rise in yields. That was raising this question of why. Was it really just that the Fed had a more hawkish tone? Was it something about the data outperforming that we'd already seen pretty consistently? If anything, the surprise index has fallen off, not increased. Why did we see such an increase in real yields, which, as Max Kettner of HSBC says, is reaching the danger zone?
Well, real yields, we go back to 2022 and 2023. I think if we take a step back, what do yields reflect? They reflect fear over inflation. So if there is a inflation surprise to the upside in the US, then real yields will need to be higher. And then as a result, financial conditions will need to be tighter. And in the US in particular, how does that manifest itself? Lower equities as well. We look at credit spreads, we look at outright yield levels, and we look at equities. FX plays a far smaller role in the US. So equities, that seems to be the last shoe to drop in terms of a tightening in financial conditions that's needed. So it all goes back to US policy at the end. Where does fiscal lie and where does the tariff situation lie? Because these two factors contribute directly to the inflation outlook up ahead. If the household is going to look at everything and say inflation is going to rise and they're going to be much more cautious and corporates respond accordingly, I think that's where the caution is going to be needed on the equity performance front as well. But again, let's cross that bridge when we get there. We haven't seen the policies yet.
Right, which is the reason why there's sort of this question, does it even matter? Do we need to come in until January 20th until we get some sort of inauguration and then a set of policies from Donald Trump? At what point can you sort of say whether you either have rates that are too cheap or stocks that are too expensive? Can you weigh in on that, or do you just basically tread water until that inauguration?
I think it's going to be quite cautious heading into inauguration. Activity levels I would expect to be low. It's not taking off risk per se, but going to what we've seen, there may be a lack of interest in putting on risk. Once we get past inauguration, when we get into Q1, by the way, if I look at Fed pricing right now, so markets not really looking for a full cut until after Q1, maybe closer to mid-year, something along those lines of the June meeting. So in that context, it's just a holding pattern for the first 6 months. And again, that's where the inflation expectations are going to build. So I'll be looking at the earnings season heading into Q1, what the guidance from corporates as well, what are they seeing from the ground? What are their contacts in Congress telling them about policy up ahead, how it's going to impact them and how the Fed's going to react? So I think that's where we're going to get the bulk of the changes. But for the next 2 or 3 weeks or so, certainly a holding pattern.
Well, Geoff, let's build on your understanding of what the policy priorities actually are in Washington, D.C., because many Republicans spent the holiday season arguing over H-1B visas. What's your understanding of what the priorities might be?
In the labour market context, I think that's where it matters for inflation, for wage growth. Look at the trouble that every single central bank has had with over the last year, over the last 2 years, really, labour supply. So this may be a smaller component of that, but the policies need to be done in a way which boost real income growth rather than nominal income growth, because if it's just nominal income growth, but then the inflation builds on top of that, people don't actually feel richer, and I think that's going to hurt sentiment as well. So if we have the right policy mix which guarantees productivity gains, again, this really anchors our thesis of US exceptionalism. Its productivity growth, potential productivity growth, is so much stronger than elsewhere. Let that guide real income growth in the US, and if there are lessons to be learned, I hope the rest of the world, especially in Europe, can actually try to emulate the US. But getting that productivity side wrong means you get real income growth wrong, and that's where you can get an inflation spiral again, but that's not our base case.
Geoff, some people believe that by the middle of December last year, the Federal Reserve was already starting to incorporate some of the policy changes from the incoming administration. Did you agree with that particular view? And where does that leave them at the end of this month when they meet again?
So I don't think they are incorporating things. So they wouldn't be flying blind in that sense. If they had a sense of, OK, 50% tariffs or 20% tariffs or whatever number you assign to that, then on a numerical basis, you can actually feed that back into your inflation models and act accordingly. Sure, maybe some preemptive action or some guidance is needed, but you can do that in terms of communication. What I think a lot of central banks are incorporating right now, if I look at the Riksbank comments, for example, from a few hours ago, they are looking for stabilization and expectations. So somewhat astonishingly, Europe is actually sounding a bit more positive right now, even though they could be on the wrong end of tariffs as well. So in that context, the growth risk and thereby the inflation risk potentially is still to the upside for this year. We can get a China fiscal boost as well. So I think that's what the Fed and global central banks need to be attuned to. Growth risk, maybe they are worried about, but inflation risk, certainly they need to look at to the upside, and that's what the bond market is telling you.
Geoff, a lot of people are looking at this and saying that a lot of the bad news has been baked in, and then we get the news overnight about Ukraine shutting off supplies of Russian gas to Europe. This was expected. It's not necessarily something that they're not prepared for, but it does increase natural gas prices on the margins, and it raises the question of greater degree of inflation. How confident are you that the ECB is able to both sort of thread this needle of fighting what you see as the potential for upside inflation while also supporting an economy that, maybe a lot of news has been baked in that's bad, but still, it doesn't look very good.
Yeah, well, to be frank, the pivot opportunity was last year, when they could have escalated or strengthened their easing. So if they didn't do that last year, where the PMIs were, given how things seem to be stabilizing, that less bad narrative, we're going to get a new German government coming through potentially. France seems to have stabilized them for now. So if that investment narrative from the Draghi report come through, I don't think the ECB is going to change its language too much, to be frank. So given my euro-dollar view right now, it's more actually the Fed pulling back from its rate cuts view at various points last year. I think that's what's driving things right now. But at the same time, I look at our flow data, I look at our positioning data. Euro positioning to the short is very, very extreme right now. So if we go through parity, have a look at fundamentals, valuation, assuming no geopolitical shocks, probably take the win, and then just look into stabilization from there, and then see how growth performs. But still, on a net basis, I still think US outperforms Europe for the time being. It's just a question of how Europe turns things around. I'll put the UK in that element as well. I think that's where the market is actually underpricing cuts. So I think that's where the central bank surprise could be relative to current expectations. Interesting.
One thing for sure, Geoff, we're set up for a fascinating year ahead. Geoff Yu of BNY. I think we should round it down. We're at parity right now. Euro-dollar 103. 103.32, lows we haven't seen on the single currency going back to November 22.
Yeah, I was looking at the dollar index and just how much it's outperformed, and I think that Geoff really summarized it perfectly. So far, it has been a story of European underperformance. Now does it shift to all the bad news being baked in, and now maybe the Fed not cutting nearly as much as people think because of this American exceptionalism. You can't have your cake and eat it too with respect to rate cuts, ongoing American exceptionalism, and potentially an economy that keeps delivering these types of stock gains.
A lot of banks did a lot of surveys to close out the year. We picked out one. I'm going to repeat it. It came from Deutsche Bank. Only 2% believe US growth will be below 1% in 2025. Only 2% of respondents believe US growth will be below 1% in 2025. That's the average expected in Europe. That gives you an idea, just a decent sense of where expectations are for US versus Europe coming into a new year.
Which is the reason why less bad was the emphasis of Geoff. At a certain point, how much bad news has been baked in to Europe, how much good news has been baked into the U.S., and it goes to the point you were saying, which is the policy mix. Do we get a sense of truly more fiscal expansion in addition to tax cuts that don't have to be paid from anywhere? Because a lot of people are saying that's not realistic, and yet that is what's getting priced into a lot of American exceptionalism.
Kit Juice, SocGen coming up a little bit later. Look out for that conversation. The euro at 103.31. With an update on stories elsewhere this morning with your Bloomberg brief, let's cross over to Danny Berger. Hey, Danny.
Hey, John. A deadly attack in New Orleans, French Quarter, very early on New Year's Day, killed at least 15 people and injured dozens. The suspect, an American Army veteran, was killed at the scene. The FBI is investigating the attack, which involved a pickup truck and improvised explosive devices. The FBI is also looking into potential connections to terrorist groups and whether the suspect acted alone. The attack happened hours before the Sugar Bowl was set to kick off at the Caesars Superdome in New Orleans. The game was postponed until this afternoon. Meanwhile, Elon Musk says the explosion of a Tesla Cybertruck outside the Trump Las Vegas hotel was probably an act of terrorism. The driver was killed and 7 people suffered minor injuries. In a series of posts on X, the Tesla CEO says the explosion was caused by fireworks or a bomb carried in the rented Cybertruck and was not related to the vehicle itself. President Biden says officials are investigating whether there's any possible connection to the attack in New Orleans. President-elect Donald Trump says that he will lobby House Republicans, if necessary, to help re-elect Mike Johnson as Speaker. Trump endorsed Johnson on Monday ahead of a House vote scheduled for tomorrow. Johnson faces criticism within the party after backing a temporary spending deal that left out some Trump demands. And that's your brief. John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the programme, the House Speakership on the line.
I think they'll support Speaker Johnson. Almost everybody likes him. Others are very good too, but they have 30 or 40 people that don't like him, so that's pretty tough.
That conversation up next, live from New York City this morning. Good morning. Let's get back to work, shall we? Equity futures on the S&P 500 up by...
I'm so excited.
0.6%. I say that reluctantly. We're up on the S&P by 0.6%, following gains of more than 20% last year and the year before. It's been a stellar run. In the bond market, yields are lower by 3 basis points on a 10-year. On the session, we're down to 453.28. Under surveillance this morning, the House Speakership on the line.
I think they'll support Speaker Johnson. I think we're going to have a great time in Washington, and I think we're going to get great support. He's the one that can win right now. People like him. Almost everybody likes him. Others are very good too, but they have 30 or 40 people that don't like him, so that's pretty tough.
So here's the latest this morning. Congress kicking off 25 with uncertainty surrounding the Speaker of the House, Donald Trump, throwing his support behind Mike Johnson with a vote set for tomorrow. James Lucier of Capital Alpha Partners writing, "Don't worry about Mike Johnson getting re-elected. As Speaker on Friday, there is no alternative, and he will be re-elected. How about a New Year's resolution for Congress? Get rid of the debt limit." James joins us now for more. James, welcome to the programme, sir. We've got a lot to talk about, including national security across several dimensions that Lisa wants to jump in on in just a moment. Let's lead where you started, though. The issue around the debt and the amount of appetite this incoming administration has to add even more debt to the national debt pile. How much appetite do you think there is?
Well, John, first of all, Happy New Year to you and Lisa. I think that most investors have been expecting Congress to pile on with giant tax cuts, unpaid for, and maybe even giant across-the-board tariffs. But what this exercise of the past few weeks show is that the ability of House Republicans in particular to execute on giant tax cuts is very, very questionable. Now, they will elect a speaker, but the fact that we've got so much drama involved in a simple setup thing like electing a speaker shows that the ability to pass large tax cuts is limited precisely because the same people opposing Mike Johnson are also people who profess at least to be against large amounts of new debt.
So, James, where do you think the policy priorities actually are?
Well, I think the policy priorities to start with are immigration, perhaps the first reconciliation bill to deal with the border and perhaps defense issues, but ultimately it is about the economics. And I do think it is about the tax cuts, both to stimulate the economy and also to redirect resources from the energy transition economy back into what we might call the old economy. I do think that we'll see tax cuts, but probably something on the order of 2 to 3 trillion that aren't paid for. And I think we'll see a real effort to add some pay-fors in there by deep spending cuts, by impoundments, meaning rescissions and deferrals of past spending, and a lot of creative efforts to find ways to offset the tax cut, to offset the cost of the tax cuts that they will probably pass. But those tax cuts probably won't come until June or July at this rate, too.
Which raises this question of how much we're baking in terms of hopes and dreams and how much that stands to be disappointed until then. I want to shift focus a little bit just because overnight we had that attack in New Orleans. We also questioning what the attack and the potential connection with the Las Vegas explosion in the Tesla car, what it might have to do with that. I'm just wondering, from your perspective, are you concerned about an absence of leadership at a time where it's quite clear that the United States is coming under attacks on multiple fronts, whether it's the physical ones and the old school ones that we're seeing in New Orleans, in Las Vegas, or whether it's some of the high-tech probes that we've seen, the leaks, the breaches from the Treasury Department on a cybersecurity level?
Well, this is an extraordinarily dangerous time. And if you've been reading the coverage in the major newspapers now, the Wall Street Journal especially, but also the Washington Post and the New York Times, there has been a real lack of response from the White House, a lack of ability from the White House to respond that may in fact be linked with President Biden's declining cognitive powers, or so it's suggested. So anytime you have a transition from one administration to another, you see probing attacks. You see new potential adversaries trying to see where the new president is coming for. So, it's a question of these attacks. It's the Treasury Department attack. How exactly will things start to unfold in Ukraine? What will happen in Gaza when Trump takes office? We tend to think of the pomp and circumstance surrounding the U.S. Marine Corps band playing Hail to the Chief. It all seems wonderful, but in fact, our adversaries are testing the White House to see what its responses are, and every president tends to be tested early in his administration, if not immediately before he takes office.
Of all the national security threats that we've been seeing over the past couple of days, let alone weeks and months, which concerns you the most? Which do you have your eye on?
Right now, we're watching Russia and Ukraine more than anything else, just because that will be topic A. What other activities could Russia undertake as part of its hybrid war campaign to try to strengthen its position, to try to force Ukraine into submission? So we'll look at that. Obviously, the Middle East and Iran is another source of great agitation. North Korea, too. So it's the usual suspects, but I would probably put the emphasis more on Russia than any of the others.
James, appreciate your time. No doubt we'll catch up again soon. And Happy New Year, sir. Forgot that bit at the start. James Lucier there of Capital Alpha Partners. James, appreciate your time. I think we're all used to this awkward period post-election from early November to January 20th. This one is somewhat unique, though, in that we have people openly questioning the cognitive ability of the sitting president. We heard that from James just moments ago.
There's a question about how present he is. There have been a number of reports and a number of major media outlets about sort of how much he's retreated and how much some of his aides are trying to get President Biden to the fore. A question here about what kind of vulnerability is there in the United States in this period? What kind of security is there going to be on inauguration? Whether some of these attacks were targeted at President-elect Trump, whether this is something else. A lot of questions. I mean, honestly, it was a reason why over the weekend I was really searching for any details. How do we put this into perspective? Right now, market's not responding, but this real question of what this means for the next 20 days.
I'm pleased you brought up the national security issues across several dimensions. Of course, the tragic attacks of New Year's Day is something we'll cover throughout this morning on Bloomberg TV, but also the cyber attacks allegedly coming from the Chinese on the U.S. Treasury Department as well. There are multiple dimensions to consider here as we all have to think about national security in the United States.
And it really focuses the efforts on the efficacy of government agencies, as a lot of people have a lot of doubts about, and frankly goes to the heart of some of the promise of President-elect Trump.
Up next on the programme, we'll shift to tech. Dan Ives of Wedbush on what he sees as the top 10 tech winners for the AI revolution. That conversation just around the corner. Let's check out the equity market, bouncing back from 4 days of losses. On the S&P, we're higher by 0.6%. A lot of people are going to talk about the big yearly return, and we should. It's a monster yearly return, again, of more than 20% following a more than 20% return the year before. But we should also reflect on how weak December was. The Nasdaq barely positive, the S&P down in December by more than 2%, the worst month for the S&P since April. On a Russell, Lisa, we were down by more than 8% on a small caps, and that's the worst month all the way back to 2022.
Which raises the question about whether we really do see tech leadership as the ongoing dominance in this market. The idea that you saw an 8.4% drawdown in the Russell 2000 highlights what a head fake it's been all year, with people talking about the equal weight, about the broadening out, about the small caps, and frankly, it came in tandem with that rise in yields.
Whipsawed. November, the best month of the year for the Russell. December, the worst month of the year for the Russell. Let's turn to the bond market. 2-year, 10-year, 30-year. Front end of the curve, the 2-year ended 23 at 424.99. The 2-year ended 24 at 424.16. The 2-year was almost totally anchored. The front end almost totally unchanged over a 12-month period. The 10-year is where you saw all the action. Lisa, a move of more than 70 basis points, almost 70 basis points higher on the 10-year last year.
Yeah, in the entire year, and 40 basis points of that came in December. And this really raises the question, why? What exactly was driving this huge sell-off in bonds at a time when nothing materially had changed? You basically had the policy prescriptions that have been baked in. You hadn't seen any kind of coming to fruition of any of those. And yeah, you had some outperformance of some metrics, but not necessarily to write home about, which raises the question, who is right? Are bonds underpriced or are stocks overpriced at a time where essentially people are saying that there needs to be a higher yield premium baked into a bond market that is facing a lot of uncertainty in 2025?
Compare and contrast the performance of bond markets elsewhere with the United States, where yields in China totally cratered. At the front end of the German curve, we dropped by something like 30 basis points, and the long end, the 10-year, rose only half as much as the US 10-year did. Now, once you've established that, push it through foreign exchange. It's part of the reason why we're looking at a euro very close to parity. Euro dollar, Bramo, 103.21.
How much bad news is baked in? And going back to Geoff Yu's point, how much is this baking in some of the negativity in Europe, but not necessarily the opposite, which is the Federal Reserve not being able to cut rates nearly as much as people previously thought? In other words, is that where the surprise is going to come from that could potentially have even more euro weakness, more dollar strength? Are we reaching the tipping point for how far this can go? These are some of the big questions. At the same time, I haven't heard one person say American exceptionalism is a farce. I haven't heard one person say that actually the U.S. is poised to severely underperform. And what I have not heard is anyone say that Europe is on the precipice of some sort of rip-roaring expansion. And that, I think, is the big question.
Which is why DXY, the dollar index, only had one down week through the whole of Q4. Only one. Just one down week through the whole of the fourth quarter. Under surveillance this morning, an attack in New Orleans, leaving at least 15 people dead and dozens more injured after a pickup truck drove into a crowd early on New Year's Day. The FBI saying they discovered an ISIS flag with the vehicle. And just hours later in Las Vegas, a Tesla Cybertruck exploding outside of President-elect Donald Trump's hotel. And now real questions about whether these two events are linked.
And those questions being raised by President Biden himself, they are investigating that. He was speaking from Camp David. A real question here about what the broader implication is, what type of prevention measures are in place, especially ahead of the inauguration, and then what further threats. I mean, we were just talking about this with James Lucier. What further threats at a time where it's kind of unclear where the leadership has come from, especially in an international sphere, when President-elect Trump has really already taken the mantle and President Biden has really stepped back.
It's a theme already to start 2025. National security issues across several dimensions. And here's another one. The U.S. Treasury Department saying it was hacked by a Chinese state-sponsored actor. The announcement coming just days after the Biden administration said China is behind a vast cyber espionage campaign affecting 9 telecommunications companies.
We've seen this sort of a drip drop of news regarding some sort of hack in a host of different tech spheres in the United States from Chinese actors, also from Russian actors. My first thought with this was, how does the U.S. government get the tech expertise at a time where that's at a premium, where all of the companies are paying top dollar for the top tech and cybersecurity analysts. How do you get those people into government to make sure that you're staying ahead of all of the potential hackers? This, to me, is a huge issue, and I want to see something. I mean, I'm curious what Elon Musk has to say about that.
At the margin, do you think that plays into the H-1B argument at the moment?
I mean, sure. I think that has to do with the government. I think that when you look at the numbers, Amazon, when you look at Microsoft, when you look at what % of their employees come from H-1B visas and people who come in from out of the country, if you look at how many openings there are in this country versus the people who are eligible to fill them, that's got to come from somewhere else. And that's the reason why Elon Musk is saying, look, we got to go with H-1B and we've got to expand and reform this. And that's the reason why Donald Trump seems to be supporting that, despite some of the pushback from some of the MAGA universe.
I think the incoming president's been pretty consistent about it, that he wants to attract the best of the best from around the world. What he does not want is them crossing the border illegally in the South. I think he's been pretty consistent about that over the last year.
The real question has been exactly what those plans look like, what the reforms look like, and how much he can get other Republicans on board when there is sort of an anti-immigration, more broadly sentiment that spans even H-1B visas. So a real question of how he implements, not necessarily any kind of inconsistency.
Dan Ives of Wedbush joining us in just a moment, so look out for that conversation on tech more broadly. Wanted to squeeze this in. European gas prices rising the most since October 2023. The region bracing for freezing winter temperatures without a key source of supply after Russian gas deliveries across Ukraine were halted yesterday. A transit contract between the two nations expiring with no alternative in place. So,
first of all, this isn't a huge surprise, right? There has been preparations for this, people expecting. Back in 2021, Russian natural gas accounted for some 40% of the imports to Europe. Now, through this pipeline, it only accounts for some 5%. But a real question about stockpiling for the future. And frankly, again, this gets the attention turned back to the White House. The U.S. is one of the major sources of natural gas for Europe in the absence of Russia. That has been an area of some debate with President Biden, a real question about whether President-elect Trump will open the floodgates a little bit more with respect to exports of natural gas from the U.S. to Europe.
He has already come out and said he'd like them to buy some more. A lot of people on this programme have come on and said he's pushing on an open door because the Europeans are ready to buy. And that was something Ursula von der Leyen said right out of the gate after his election win in early November.
So let's see how quickly that can get implemented, and let's see what that does to pricing. Does that actually increase prices in the U.S., given the fact that the international divide between Europe and the U.S. in pricing in natural gas has increased, actually, during the whole of this conflict?
We'll get the latest from the Bloomberg team in the next hour, so look out for that. Let's turn back to tech. Dan Ives of Wedbush writing, we expect tech stocks to be up 25% in 2025 as the street further digests a less regulatory spider web under Trump in the White House, with Khan's FTC days in the rearview mirror. Stronger AI initiatives within on the way, and a Goldilocks foundation for big tech and Tesla looking into 25 and beyond. Dan Ives joins us now for more. Dan, good morning.
Great to be here.
Happy New Year, sir. It's good to see you. We can talk about some of these big gains through 24. Palantir up 340%, Nvidia up 171, Tesla up 62. Here's another one. Vistra up by 258%. That was the biggest winner on the S&P 500 last year. That's a utility company.
Yep.
What does that tell you about the state of play in AI?
It's about second, third derivatives of AI. I mean, I think the big thing is it's $2 trillion of AI CapEx next 3 years. And I think, look, that's numbers that are really, I believe, going to be in stone. And there's a multiplier. For every dollar spent on an NVIDIA chip, there's an $8 to $10 multiplier across software and across the rest of tech and infrastructure. You think about the power, the utilities, nuclear energy, names like ACO and others. I mean, it just speaks to we're going into a new age. It's not just about big tech. I mean, to your point about small caps, I think the big sort of prove-it moment is the multiplier playing out. It's the rest of tech, the rest of utilities, the rest of the market participating in this AI trend. That's really, if you think about that party, the only ones let in behind the velvet ropes have been that Mag 7.
Nvidia has been selling the picks and shovels. They've made a fortune. We've seen all the growth. Does Microsoft and Google and the like that have been spending all that money need to show some gold this year in a big way?
Yeah, and I think that'll start this quarter. I think you're going to see an inflection point in the hyperscalers for Microsoft, for Amazon, for Google, in terms of what we see with more and more of those cloud workloads now showing up. And I think it's all about use cases. That's why you look at the Messi of AI, Palantir, you know, in terms of what they've done. That's just the first piece. Salesforce has been another. Software now starts to actually participate in this AI revolution. That's going to be a key theme across 2025. Remember, with Khan done at the FTC, M&A is going to massively accelerate. And that's another theme we're going to be seeing across tech.
What we saw at the end of last year was a lot of these other companies, sort of the side effects of AI or the actual applications. We saw them take a pause in the applications of AI and really study exactly the use cases, study the most efficient way to do it. They stopped deploying as much cash. What makes you think that they can apply some of the AI technology quickly enough to keep delivering the kinds of expansion and gains in the hyperscalers to keep a 20-25% return that you're expecting in 2025?
Yeah, it's a great point. Look, that's all the work we do. I mean, we look at, when we talk to enterprise around the world and all the travel we do in Asia, it's showing that these use cases, they're exploding for the enterprise. So as the ROI starts to continue to increase, that's why you're starting to see, you saw Palantir starting Salesforce, you're going to see Mongo, Snowflake, and others. You're going to see it spread across the board on enterprise. But again, like the ships left the port. In other words, the AI CapEx is going to be there. Now 2025 is going to be about showing it, proving it in numbers. And that's why the reason we think tech stocks are going to be up 25%, it's not just about big tech. It's about the rest of tech participating, software, infrastructure. And look, I always say, like, haters hate. The last few years, that's sort of been, what we've seen in tech. They will continue to sort of fire in a crowd theater type situations, but I think tech continues to move higher.
How predicated is this theory on the idea that there can be some sort of expansion of the H-1B visas, that there can be an ongoing increase in employees and top talent to the United States?
For the first time in 30 years, the U.S. is ahead of China. I mean, in my perspective, from when it comes to tech. But to fuel that in terms of AI revolution, it's talent. And I think what we've seen, we've definitely seen a lack, I would say supply, demand. These companies more and more need to continue to fuel this with talent. So when you look at what we're seeing with H-1B and ultimately as that all plays out, it will be something very, very important that plays out in Silicon Valley and across the tech world in 2025.
Elon Musk has been at the forefront of this debate, this argument over the holiday period. Let's talk about Tesla. Tesla, an outlier in a pretty dreadful auto market, particularly for the European players. I think it was Stan Druckenmiller that once said, you'd be surprised by how few people understand what makes a stock go up or down.
Sure.
What makes Tesla go up or down? Because it sure as hell doesn't seem to be car sales. It seems to be something much bigger than that.
And we're going to have deliveries probably in the next few hours, right, in terms of Q4. Look, I think this is an autonomous AI story for the next few years. And it goes back to the bet for the ages that Musk made on Trump continue, I think is going to really play out as the autonomous future. That's what you're betting on in Tesla. You don't see that in numbers today. But I think ultimately, I think that's worth $1 trillion alone in terms of the AI autonomous story. But next few hours, this week, we'll be talking about deliveries. And it comes down to China deliveries, which were really a disaster at points in the last, call it 12 to 18 months, have now started to rebound for Tesla. And that's going to be very important.
What gives you the confidence that that will continue? Because there are some similar questions happening in the luxury space with companies like LVMH. Is China actually bottoming out for the consumer side of things? What gives you that confidence for 25?
It's what we see in terms of demand, in terms of what we see in terms of the overall China market for EVs. I think Tesla, I think a lot of those price cuts in the rearview mirror, we're going to have white knuckle moments. But ultimately, I think China is something that could be up 20% when it comes to delivery for Tesla. And that's why I think right now it's one where I think where the bears have sort of misunderstood Tesla, it's 10 to 15% of delivery story now. It's 85, 90% AI autonomous in terms of the future for Musk and Tesla.
Sort of when you put together some of the things that you're talking about, you think for the first time in 30 years, the U.S. is actually ahead of China when it comes to development. At the same time, Tesla's dominance and success has hinged on its success 100%. In China. So how do you see the evolution in 2025 of the increasing divide, the increasing isolation between China's sort of tech stack and the United States' tech stack, and how those sort of both compete but also evolve in parallel?
Yeah, and it's a game of high-stakes poker, because the reality is that the reason Jensen's godfather of AI and what we've seen with NVIDIA, where the chip's coming from China, coming from Asia. So that's why we're going to see this all play out with the China tariff discussions. I believe Musk is going to be heavily involved there. Cook, 10% politician, 9% CEO. Apple also plays a key role here. But I just believe that's something that ultimately it's not going to spoil the AI revolution trade. It's not going to spoil the chip trade. We will go through white knuckle moments, but my view, and it's been the playbook the last few years, you buy the winners on those opportunities. And I think that's going to be the theme this year.
Pick the winner of the year. Your number one stock pick for 25. What is it?
I think, to me, number one stock pick, I think, continues to be NVIDIA here. And the reason it is that there's only one game in town when it comes to AI. It's the godfather of AI, Jensen NVIDIA. Stocks obviously sold off. I think we sit here, them along with Apple will be the first ones in that exclusive $4 trillion market cap club.
Wow. The stock is up again this morning by 1.6%. Dan, Happy New Year.
Happy New Year.
Good to see you, buddy. Thanks for being here. Dan Ives there of Wedbush with an update on stories elsewhere this morning. With your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. Chinese stocks posted their worst start to a year in nearly a decade. The CSI 300 closing lower by nearly 3%. Manufacturing data posted earlier this morning showed a slower pace of expansion in December. In December, China signaled more public borrowing and spending in 2025 with a shift of policy focus to consumption in an effort to repair the economy's weak links. Sun Art shares tumbled by a record in Hong Kong after Alibaba agreed to sell its holdings in the hypermarkets operator to a PE firm. The Chinese e-commerce giant could receive up to $1.6 billion from the sale to DCP Capital. That's much less than the $3.6 billion it paid in 2020. That deal accelerates Alibaba's retreat from physical retail spaces, focusing instead on the cloud and online marketplaces. UK house prices climbed to within touching distance of a record high to end 2024. A resilient property market that gathered just more momentum. It was the fourth consecutive monthly increase. Data elsewhere showed solid buyer demand. Despite affordability challenges, UK house prices are expected to climb 4% in 2025. And that's your brief. John.
Hey, Danny, thank you. Danny will be back in about 30 minutes' time. Up next on the program, dollar strength persisting.
We had a much stronger dollar for the first 6 months of the year against a trade-weighted basket of currencies. You're going to continue to see growth differentials and interest rate differentials drive the value of the greenback.
Kit Juckes of Societe, just around the corner. Stocks are up, bond yields are lower. We're higher by 0.8% on the S&P. On a 10-year yield this morning, we're down by 3 or 4 basis points. But check out the euro, weaker again, 103.28. The low of the session, 103.14. The lows we have not seen since November 2022. Some euro weakness, that's for sure. Under surveillance this morning, the dollar strength persisting.
We had a much stronger dollar for the first 6 months of the year against a trade-weighted basket of currencies. You're going to continue to see growth differentials and interest rate differentials drive the value of the greenback. The question is not will the dollar get strong, but will we get in a situation where the fundamental underlying strength of the U.S. economy, with that new policy piled on top of it, turns us into a situation where the dollar soars and we get calls for dollar devaluation.
So here's the latest this morning. Traders watching if the greenback can sustain its momentum this year after its strongest yearly advance in nearly a decade. Kit Juckes of Societe writes, given the recent economic and political trends, dollar bears should hibernate over the winter. Spring shoots of life in the European economy, signs of fatigue in this incredible US cycle, and clarity on the policies of President Trump may all help by summertime. Patience is required through the winter and spring. Kit joins us now to kick off 25. In the FX market. Kit, Happy New Year and welcome to the programme, sir. Let's start with US exceptionalism. What is it built on and how sustainable are those pillars?
Some of it's sustainable. I mean, the technological gains, you've just been talking about them, they're a huge part of it. If we believe in the AI revolution and we believe in Mag 7 and everything that's happening, then you know, the US has cornered that. So let's not knock that. I wouldn't necessarily knock the fact that the US has run a significantly more accommodative fiscal policy since 2020, really. You know, everybody in Europe's been struggling to try to get their budget balances back under control. the US has kept them a competitive policy and has had more growth, and that helps keep the deficit a little bit more under control than elsewhere. So there's more than one piece to this that's been that. But if the US does have to tighten fiscal policy at some point, that may slow things down. We'll see how big the AI revolution really is in the next 10 years or so. I am not clever enough to judge quite how much continued growth that can give. And we'll see whether the US can cope with the demands on the labor force, because the economy is running at this point on wealth gains from asset price increases, a tight labor market, a fairly divided economy in terms of winners and losers. And it doesn't look to me as if it's got much potential to accelerate in growth or indeed to continue at recent growth rates for that long, unless we can get a productivity miracle from somewhere.
What do you think is going to drive further dollar strength if we get it, or perhaps euro strength? Will it be European disappointments, European surprises to the upside? Will it be rate differentials, or will it be ultimately just a real question of what the neutral rate is in the United States?
I think the neutral rate is look higher in the United States than in Europe, and that's a challenge that doesn't get written up about enough. Just that if my neutral rate's higher than your neutral rate, my currency ought to be going up forever. I mean, it's not a stable equilibrium if we have these big divergences in neutral policy rates. So that's a major factor, but I think it's largely in the price. What I'm most uncertain about is the politics, in the sense of, have we priced in too much of what people expect from President-elect Trump, or have we not priced it all in at all yet in terms of what that does for the dollar? I've read so many pieces talking about the possible negative growth effects of his tariff proposals, plans, threats, whatever we want to call them. If he wants to get a deal that's good for the US, it has to be a deal that's good for the world and good for global trade. And if he does that, there's more upside to growth elsewhere than there is in the US from those deals, if only everybody can embrace them. And that wouldn't be good for the dollar. So at the margin, I think the politics will be more important than the kind of straight economics. If all we're doing is trading what's happening economically now, I think we're just going to have a very strong dollar for as far as the eye can see. The debate about whether it can get back to parity for Eurodollar or a little bit stronger generally than it is now, it's a tough debate. It's a really expensive currency that will stay expensive as long as the rest of the world is shoveling all of its savings into the United States to see how much money it can make out of the U.S. equity market.
Just quickly, is the spike that we've seen in natural gas prices in Europe just noise, or is that something you're watching that could potentially affect the pair?
Oh, I think we have to watch it pretty closely. I mean, it's we've known this was coming for long enough that you'd have thought some of it would be in the price, but with raw materials, nothing ever is, right? If the pipes close down and it suddenly gets really cold, then you can have a short-term spike that can have a short-term impact on growth, that can have a short-term impact on the currency that's pretty negative. That the way we got Eurodollar to 95 back in 2022 was a terms of trade shock caused by higher gas prices. So we shouldn't ignore it completely.
Hey, Kit, good to see you. As always, Kit Juckes there, SocGen on foreign exchange. Euro-dollar 103.25, the lowest level for that currency pair going back to 2022.
Yeah, and this really speaks to the fact that the strongest performance that we've seen in Europe are some of the tourist locations where a lot of international tourists are going. And I know some people are saying, oh, there you go again. But truly, how many people went to Europe over the winter break because it is just so much cheaper given where the currency is?
Have you booked yet?
Maybe. I don't know. Have you?
I have.
OK.
I'll admit. Are you going to admit that you have now?
Maybe. I don't know. I'll decide. We have it in a couple hours.
I imagine we're not alone at 103.26 on Euro-dollar. Up next in the second hour of Bloomberg Surveillance, we'll catch up with Sarah Hunt of Alpine Saxon Woods. We'll speak to Bloomberg's Tyler Kendall and Will Kennedy, and we'll catch up with Earl Davis of BMO on the bond market from New York City. Welcome back. This is Bloomberg.
think markets are still really euphoric.
The sentiment dial has been turned up significantly to end 2024. We think that's becoming a bit of a liability as we walk into next year.
The next couple weeks we think are going to get a little choppy.
I think we're actually going to get off to a bit of a sloppy January.
As goes January, so goes the year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Let's set some boundaries. January 10th.
Yeah.
That's like the deadline for Happy New Year's.
Because it's payroll day? Is that why?
I think once you get some real economic data, it's no more Happy New Year.
Yeah, I'm going to debate
That's my
that.
view.
I actually think that if you haven't seen someone through the whole of January, you can say Happy New Year.
If you haven't seen them for that long, they're not that important to you, and it's disingenuous.
Okay, well that's
how about that for a comeback?
I personally, I'm inclusive. I'm trying to bring people into my orbit. I think it's wonderful. Happy New Year.
Happy New Year to you too. On this January 2nd. Equity futures on the S&P 500 positive by 0.9%, on the Nasdaq 100 up by 1.1. Speaking of January 10th, payroll's just around the corner, not tomorrow, but the following Friday. Then on the 15th, you've got CPI. On the 20th, inauguration. And then at the end of the month, you'll hear from the Federal Reserve.
Yeah, and to me, here's a question. We've seen a real shift upward in yields, and there's a question about why. Is it justified? Is it because the economic data has been better than expected? Or is it because there is this promise of some sort of fiscal package that will increase the deficit and that will thus increase the yield premium? This is the key, frankly, to where January goes and thus where some of the tone will go, because that has been behind some of the hiccup that we saw in December.
We've got to talk about where we have been and the month of December. I mentioned that we'd had this 70 basis point move on a 10-year yield through 2024. And Lisa was fast to point out that 40 basis points of that came in the month of December. The world is becoming really stretched. Jay Pawlowski would come on the programme and talk about the tripolar world. Let's talk about those three poles. The United States seems to be heading in its own direction. China's heading in the opposite direction, and Europe seems to be stuck somewhere in between. And I'm not sure how much more stretched this story can become in 25.
Yeah, another way of saying that is, how much has this been fully priced? This idea of American exceptionalism and everyone else falling off a cliff, is that where the surprise really could potentially be? And that's what we heard from Geoff Yu of BNY Mellon, that basically there is more upside surprise in some of the laggards. That said, where is that exceptionalism going to come from? I will just point this out. We were talking at the end of last year about how the economic surprises in the U.S. kept inflecting to upward. Actually, the Citi U.S. Economic Surprise Index went negative for the first time since October by the end of the year. So it raises the question of, is the data starting to lag behind, and question maybe how much momentum there is behind that story?
Relative to expectations, and I can give you a sneak peek of the payroll survey here at Bloomberg. A number of economists have already posted their estimates for next Friday. 153 is the median at the moment. 153K, that would be down from 227. That's the latest look. I'll give you another look tomorrow morning. Coming up this hour, we'll catch up with Sarah Hunt of Alpine Saxon Words as stocks close out their best two-year run since 1998. We'll speak to Bloomberg's Tyler Kendall as law enforcement probes a possible link between the New Orleans attack and the Vegas Cybertruck explosion. And we'll catch up with Earl Davis of BMO on the fixed income outlook for the year ahead. We begin this hour with stocks looking to snap a four-day losing streak, a weak end to an otherwise solid year of gains. Sarah Hunt of Alpine Saxon Words staying cautiously optimistic into the new year, writing, what will January bring? Perhaps a bit of a relief rally after the year-end letdown. After 2 years of 20% plus returns on the S&P and even better returns for the Nasdaq, it is difficult to build in a third strong year. Sarah joins us now for more. Sarah, good morning and Happy New Year to you.
Happy New Year.
It's good to see you.
Good to see you.
Let's start with your point. I think it's really important. We've had 20% plus returns, 23, 24. How rare would it be to see something similar in 25?
It would be quite rare. It doesn't mean it can't happen. I mean, certainly for this year, people were not expecting double-digit gains at the beginning of the year. And I think that it's really just a question of tempering expectations and saying, you know what, we've had this great run. I don't think a disaster is looming, but at the same time, to expect that kind of performance year in and year out seems very surprising, especially given where valuations are. You'd have to see a really good economic backdrop. And to your point about the tripolar world, the U.S. is in one place and the rest of the world is in other places.
Talk to us about where these surprises came from. We've reflected on this before, but the numbers are important for the year before as well. The year before, looking out 12 months, the average forecast was 4,800 and the S&P closed the year at 5,881. So the S&P 500 finished 1,000 points higher than we expected it to. Where did that surprise come from?
I think it came from a couple of different places. I mean, if you'd looked at earnings estimates at the beginning of last year, just sort of the way we look at it at the beginning of this year, I think people thought, including ourselves at one point, that that was a little bit optimistic. But you really had stuff come through on the earnings front. So the AI story, which was just a backbone building exercise in the beginning, started to broaden out and other people started to talk about it and companies really started making money. And that made a big difference into both earnings and sentiment. And you layer on the sort of quantum computing and where that goes, we don't know, but it's another leg in that technology story. And I think that that optimism is really helpful. But we were also starting from a different place. So from valuations where we're starting here versus last year, even if you do get the growth that people are starting to build in, you're kind of growing into your earnings as opposed to being able to expand your multiples some more. So I think that's a little bit where the hesitation in growth comes from.
2024 was kind of a confusing year because you had a lot of stories kind of layered on top of one another. You had underperformance of the Russell 2000 while you had that outperformance of those tech accelerators in this sort of revolution that we just heard about from Dan Ives. Can that continue powering the gains? Do you have to kind of keep hiding out in that tech story and not necessarily bet on the rest of the universe that just had a terrible month, actually?
So I think the thing is it's more about an and than an or, because I think that the tech stocks and the tech sector is going to continue to perform fairly well, and you've seen a lot of excitement there, but there needs to be a little bit more of the and that Russell underperformance that we've been talking about is now getting to historic levels, both from size standpoint and from a timing standpoint. But the economy has to be in pretty decent shape, and I think that people are okay thinking that the U.S. is in pretty decent shape, but some of those companies also need the global economy to be good as well. And the interest rate picture does reflect on the small caps and the mid caps. And I think that's part of what was a problem in December, which is where a lot of that underperformance after starting to catch up in November came back through.
As John was mentioning, we saw an 8.4% drawdown in the Russell 2000 in December. That was the biggest monthly decline since September of 2022, and it came with a 40 basis point increase in benchmark 10-year yields. Are rates cheap or are stocks expensive?
Yes. I think, again, it's a combination of things. Stocks are expensive. Are rates cheap? I'm not really sure how that's going to play out. There are so many factors at play on the rate market because it's partially the Fed, it's partially concerns about the deficit, it's partially about where spending is going to go. And globally, we have a lot of indebtedness that continues to climb. And so far, that's been okay, and it's been okay. And at some point, it's not going to be okay. And I don't know when that point is. You could argue it should have been before. You could argue it'll take another 2 or 3 years. I don't know, but it clearly ends up having an occasional spooking effect. And then when that happens, equities start to wobble because they get worried that if rates get higher, they're going to have trouble given the fact that you've got multiples where they are.
Some of this speaks to how difficult the balancing act will be in Washington, D.C. for the incoming administration. They want a high-growth economy. They want a low-inflation economy. At the same time, they want a sustainable fiscal trajectory. How difficult is it going to be to balance those three things?
Now, when you throw tariffs into that mix, and that even adds another level of complexity, I think it's very difficult to balance that. And I think that's where the market shifts from enthusiasm for what might be good to concern about what might be bad and back and forth. And I think that's what you saw in December after you had that fight over the CR. Right? You had all of a sudden people going, well, if there isn't consensus, then maybe we don't get all those things that we're building in as quickly as we want. And some of these things that we're worried about can come to the fore. And I think that's where you have some real tension as to how this is going to play out. And the beginning of the year, I think, could be quite volatile.
Do you feel more comfortable betting on them being right about at least one of those three things over the next 4 years? And which one would it be?
I think that the U.S. growth situation is in pretty good shape. And I think that if you don't step on it or if you take some of the things that are slowing it down, some of that regulatory push off, some of the things where you have, I think that could be really helpful. But the rest of the world also has to do fairly well. And you have a lot of different tensions between spending. We've been in a good economy and spending money like, the proverbial sailor. So I think that there are some questions about whether or not that's sustainable and how you rein that in and to what degree that starts to impact growth as well.
At a certain point, what's your biggest concern for this year? Is it an acceleration or sort of an upside surprise in inflation? Or is it a downside surprise in some of that growth trajectory that you're talking about in the United States that's powered the global economy?
I think some of the concerns would be where the data is going to go, because we had a lot of revisions on the employment data, and that was one of the things that people were pointing to say the U.S. economy is very strong. We had some revisions that said maybe it wasn't quite as strong as we thought it was. So I think that inflation seemed to have been a big worry for the Fed when they cut in December, but it also seemed, then we got some data afterwards that maybe took some of that staying out of it. So I'm less worried that that's a huge problem than I am that it's just a constant problem that makes other things a little bit more difficult. I think really the U.S. economy is probably the biggest it's the biggest driver. So it needs to do well for those earnings to come through, for companies to do well. That needs to continue. And if it starts to look like it's not, that might be a problem. The LEI index had been negative for a while and actually flipped to positive for the first time, I think in November or December. So there's some good news in there, but I think that's mixed economic data. I think that's a concern.
We have 18 days until the inauguration of President-elect Donald Trump. A real question right now about a vacuum of leadership and the potential attacks that we've seen. I'm just wondering how, from a market's perspective, you view some of these developments, at what point they weigh on some of your outlook or some of your investing decisions, or is that just completely independent?
Unfortunately, a lot of things that are negative that happen like that don't end up being as enormously predictive for markets as you would think that they might be. So something like what happened in New Orleans and something, if it starts to become like, oh, there's a really big thing going on here and they're all linked together, I think that does start to weigh on people's consciousness and psychology and everything else. But I think it's a lot about where, are we going to see more things like that, or where are things going to go? And if we continue on a reasonably good economic trajectory, people don't tend to focus on that as much, except from a news standpoint as opposed to from a market standpoint.
Have you got a favourite sector for the year ahead?
It's interesting because I was thinking a lot about that, and I think it's more about a theme than it is about a sector and who participates in those themes. So all the things that we've been talking about for the last year, not just AI, but all the contingent things that go around it. We need a lot of power generation. We need a lot of infrastructure. There are a lot of things that are going to happen that we need things for, and that plays into the industrials, it plays into parts of the real estate market, the data centers, it plays into all the utilities, it plays into a bunch of different places. So I think it's more about those themes than it is about specific sectors.
Some of those utilities had a stunning year last year, that's for sure. Sarah, it's good to see you. Happy New Year. Sarah Hunt of Alpine Saxon Woods. We can keep doing it for another week or so until January 10th when we get payrolls.
And then it's over.
We do get a sprinkle of economic data before then. It's worth pointing out that a little bit later this morning, Lisa, jobless claims come at 8:30 Eastern Time. Later on today, of course, 9:45, the S&P Global US Manufacturing PMI. Tomorrow, ISM Manufacturing to close out the week.
Yeah, and actually, jobless claims used to be important, and suddenly they flatlined. And at a certain point, I wonder when that's going to become an important indicator. PMIs are going to be an important indicator, too. And this is something people are pointing to, especially as they roll over in China. Can the U.S. continue to see expansion in services with a catch-up in manufacturing, or does that continue to stall going forward?
Your point on claims is an important one, though. The estimate today is 221. The previous week was 219. We had this Q3 employment head fake that shook this whole market. Remember, the Federal Reserve was going to cut interest rates aggressively, more than the 100 basis points that they delivered, because it was time. You needed to insulate the labour market, and that was going to unlock a ton of what? Dollar weakness. That was the story only 3-4 months ago.
Yeah, this whole question from Jay Powell about how we will not welcome any further weakening in the labor market. This is why there was such a shift in tone from the Federal Reserve, and could be one of the reasons why we saw such a backup in rates. If we see a big increase in initial jobless claims, does that unwind some of what we saw in December?
Claims data later on this morning, 8:30 Eastern Time. Let's get you an update on stories elsewhere with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. A deadly attack in New Orleans' French Quarter very early on New Year's Day killed at least 15 people and injured dozens. The suspect, an American Army veteran, was killed at the scene. The FBI is investigating the attack, which involved a pickup truck and improvised explosive devices. The FBI is also looking into possible connections to terrorist groups and whether the suspect acted alone. The attack happened hours before the Sugar Bowl was set to kick off at Caesars Superdome in New Orleans. The game was postponed until this afternoon. Elon Musk says the explosion of a Tesla Cybertruck outside the Trump Las Vegas hotel was probably an act of terrorism. The driver was killed and 7 people suffered minor injuries. In a series of posts on X, the Tesla CEO says the explosion was caused by fireworks or a bomb carried in the rented Cybertruck and was not related to the vehicle itself. President Biden says officials are investigating whether there's any possible connection to the attack in New Orleans. Elsewhere, Bloomberg reporting that Nippon Steel has offered a 10-year guarantee that it wouldn't cut production capacity at U.S. steel mills in Pennsylvania and several other states without approval from the Treasury-led review panel. The proposal aims to address concerns raised by the U.S. Committee on Foreign Investment, which said the takeover would lead to a decline in American steel output. The report gave U.S. steel shares a boost on New Year's Eve, but President Joe Biden is still expected to block the deal. That's your brief. John.
Danny, thank you. The deal offer that just will not go away, will it?
Well, the idea that they're doubling down now ahead of President-elect Donald Trump getting in and the market thinking that maybe this is going to take some have some legs.
More on that story a little bit later. Up next on the programme, an important conversation. US security in the spotlight.
We're tracking the explosion of a cyber truck outside the Trump Hotel in Las Vegas. Law enforcement and the intelligence community are investigating this as well, including whether there's any possible connection with the attack in New Orleans.
That story up next. The average forecast, or guesstimate as we might call it, on the S&P 500 for year-end this year is about 6,600 on the S&P after closing last year at 58.81. Just a series of big calls, including Oppenheimer's John Stolfus, looking for 7,100 on the S&P 500. Equity futures this morning up by something like 1%. Your day ahead, we've got some jobless claims a little bit later this morning. S&P Global Manufacturing PMI at 945. Then on to tomorrow, ISM Manufacturing. Then next week, it really starts, Bramo. January 10th payrolls. The week after that, CPI. Week after that, inauguration. Week after that, a Federal Reserve decision.
And this comes on the heels of seeing a pop-up in yields and a pop-up in expectations for the U.S. exceptionalism at a time where we just came off the biggest two-year gain in the S&P 500 since 1998. When you take a look at some of the expectations, this is going to essentially be whether people have too much good news baked in or not enough at a time where the U.S. economy continues to outperform.
You mentioned the bond market, big moves through last month, 40 basis points higher on a 10-year. Over the last year, up 70. The 10-year this morning, down about 4.53. Under surveillance this morning, U.S. security in the spotlight.
We're tracking the explosion of a cyber truck outside the Trump Hotel in Las Vegas. Law enforcement and the intelligence community are investigating this as well, including whether there's any possible connection with the attack in New Orleans. Thus far, there's nothing to report on that score at this time. While this person committed a terrible assault on the city, the spirit of our New Orleans will never, never, never be defeated.
So here's the latest this morning. Officials investigating a pedestrian attack in New Orleans that killed at least 15 people. This is police in Las Vegas investigate a Tesla Cybertruck explosion outside of the Trump Hotel. President Biden saying federal law enforcement is looking into a potential link between the incidents. Bloomberg's Tyler Kendall joins us now from the White House. Tyler, welcome to the program. Let's just start with the possible link. What evidence do authorities have that indicates these two events might well be linked?
Yeah, good morning, John. So as you mentioned, and we heard President Biden saying that the FBI is looking into whether or not there are any potential links. We are still waiting for additional information on that front. I can tell you that law enforcement officials in Las Vegas have confirmed that they are working with Elon Musk on their investigation there into how this explosion happened. Now, in terms of what we do know about that explosion, the officials in Las Vegas have noted that Elon Musk has provided them with extensive video footage from Tesla charging stations across the country so that they could track this vehicle's whereabouts up until the point of the explosion. Now, in a series of posts on X, Elon Musk says that his team at Tesla has confirmed that it wasn't necessarily an explosion of the Cybertruck itself, but rather that a fireworks or a bomb were likely planted into the bed of the truck that ultimately caused the destruction. Now, he went on to say that ultimately it was how the Cybertruck has been built that has helped to contain the blast. Law enforcement officials in Las Vegas, too, also noting that that likely helped to contain the blast and minimize the casualties and injuries that we saw from that event.
Tyler, do we have any intel in terms of whether the threat is persisting or whether there is any additional incidents that people are investigating that could potentially be connected?
Well, I can tell you that here in Washington, we're already starting to see reaction and also security start to ramp up, right? The D.C. police in a statement late last night saying that they are going to ramp up security here in the nation's capital ahead of what is expected to be a busy month between January 6th and, of course, the inauguration on January 20th. We're also starting to see congressional reaction saying that they have to start to take action to confirm President-elect's nominees, particularly when it comes to national security picks, in order to prevent any future attacks like this happening so that they they can all get on the same page when it comes to the nation's security.
And Tyler, this comes at the same time where there's reports of a potential hack into the U.S. Treasury Department. We've been talking all morning about the multifaceted threats to the U.S. government. How much bipartisan support is there to really come up with a comprehensive plan to hire the personnel and to make sure that there is the oversight to prevent these types of attacks?
Right. I would say it's actually incredibly high. Securing the nation's intelligence infrastructure and also cybersecurity has been a bipartisan push during actually the Biden administration, and we're expecting to see it also continue into the incoming Trump administration. Of course, when we're talking about potential foreign actors in these issues, China, for example, has long been a bipartisan cause for both Republicans and Democrats on Capitol Hill, and we're already starting to see lawmakers step up and say that they're ultimately going to need to take action here.
Tyler, we had a guest on in the last hour who questioned the president's cognitive ability and whether foreign adversaries are testing the United States of America if we're at a vulnerable time awaiting the handover of power, the transition on January 20th. What do those conversations sound like in the nation's capital?
Well, I would tell you that right now, one of the biggest issues that the nation's capital is facing is the upcoming speaker election tomorrow. And there's already starting to be grumblings about how that could potentially impact January 6th, which is the certification and the count of the Electoral College votes, likely to go off, as Republican leaders are hoping, without a hitch. But ultimately, President-elect Trump is starting to get involved in those negotiations because he is trying to qualm all of those fears that there could be any issues with getting that certification done. He's trying to make sure that he can push his agenda on congressional lawmakers, but we're going to have to wait and see how effective that ultimately becomes. For example, we just saw last month when he tried to weigh in on keeping government spending open, that ultimately backfired on him as he tried to push lawmakers to lift the debt ceiling. And we're starting to see more congressional Republicans come out and potentially voice opposition against House Speaker Mike Johnson, despite him having President-elect Trump's backing.
Tyler, appreciate your time. A range of issues there. Tyler Kendall there of Bloomberg in the nation's capital in Washington, D.C., as this country faces some national security issues across several dimensions. Speaking of the incoming administration, Anne-Marie, who's not here today, has said this a million times, that in the early part of this administration, everyone's a Joe Manchin in Congress. And we're seeing some evidence of that already over the past few weeks.
Basically, that the squeaky wheels are going to get all the attention and that, frankly, there hasn't been the cohesiveness, which is probably the reason why Mike Johnson has the backing of President-elect Trump and when he is going to lobby for him, because there is nobody else who could potentially win. He has basically come out and said that. A real question here about what this means for policies and how much can actually get through. That's the reason why people are focused so much on tariffs and things that can be done unilaterally rather than things that require some sort of consensus among the Republican body.
And I still don't think the consequences of tariffs are fully understood because it's difficult to understand them. It matters how they'll be calibrated, how they'll be executed, whether people will retaliate, all of those things and more. There are so many variables that go into this. It's too simplistic to come on the programme and say it's going to be inflationary. We don't know how inflationary or whether it will be inflationary at all because we don't really know how they're going to be implemented or how they're going to be formed in the months ahead.
Let's talk about washing machines. Remember when that was the
Sure.
focus of the tariffs back in 2017? At the time, people thought this is going to be really inflationary. And it was. Prices went up significantly on a number of washing machines. And then people didn't buy those washing machines. And suddenly people delayed those purchases, and it had a depressive sort of impulse on activity. That's the type of thing people are looking at. The caveat this time is, A, we're coming off an inflationary cycle, but B, more importantly, it's not necessarily going to be so targeted on such a narrow slice of overall products, and that is what people are really questioning.
Then you've got the FX channel. Then you need to think about investment decisions for companies that actually want to be present in the United States of America. How many bankers have come on this programme over the last few months and said there are a ton of companies looking to increase their presence in the United States? It's very difficult to draw a conclusion about what all this means. We'll sit here in 12 months' time and say, yep, that was obvious. It's not obvious at all.
I don't think we're going to sit here in 12 months' time and say that was obvious. But, you know, if anyone is, Happy New Year. And I look forward to Happy New Year in 2026.
Equity futures right now in the S&P up by around about 1 full percentage point. Next up on the programme, Bloomberg's Will Kennedy as Russia and Ukraine end 5 decades of gas transit to Europe. That conversation up next. Thank you to the team here at Bloomberg for this stat. The year ended with a 4-day losing streak, the longest losing streak to end a year since 1966. Who knew? We're bouncing back from that 4-day losing streak this morning on the S&P up by 1%, on the Nasdaq up by 1.2. We're 2 hours away from the opening bow. With your morning movers, let's cross over to Manus Cranny. Good morning, Manus.
Jonathan, good morning. Happy New Year. I think 1966 was something to do with England and the World Cup, but I'll check that on the stats. Now, Nippon Steel. Anemic, 1%, relative to Tuesday's ramp higher by over 9%. There's a Hail Mary of a deal has come across the table for US Steel from Nippon Steel. We will let you decide what level of production we deliver. It really is an opportunity for Biden to consider having a veto, or the next administration having a veto, over whatever cuts in production for US Steel might be. Do some math. By the way, it was Derek Wallbank did this. The offer price for US Steel is double nickel, $55. The trading price, as you can see, is $34.33. Still a deep, deep discount, which says that the market does not believe necessarily that the $55 price tag will go through. There's a 10-year guarantee with this offer from Nippon Steel. So it's certainly one to watch as we count down. The countdown clock is running on that. Tesla, you've had a conversation with Dan Ives. We're waiting for the delivery numbers, and I think, as he said, look, 10 to 15% of this stock price is about delivery, 80 to 85% of this stock price is about autonomous driving and AI. But right now, today, we are focused on whether they can deliver over 500,000 vehicles in the fourth quarter and take them up over the line and the promise that Elon Musk made, which was, again, a potentially beating 2023, which is 1.81 million vehicles. This stock has put on $733 billion since the election. BYD, of course, choking up another record in China. Everybody's problem, not just Tesla's problem. I'll leave you with a snapshot. It's a vicarious trade. Is it still as highly leveraged MicroStrategy to Bitcoin? That correlation is maybe just beginning to unpick a little bit. You're looking at 346% ramp in MicroStrategy 2024. Bitcoin up 121%. It's a 3-to-1 leverage ratio, but that relationship is just breaking down ever so slightly in the last month of the year. Still, the coalition of the willing, Bernstein, TD Cowen, and Barclays, have a ticket in at $546, 77% upside on this if it continues to trade in the style that it did last year. Jonathan, good morning.
Manus, good morning, and thank you. And just go back to the start of that conversation. Manus, of course, is right. 1966, for anyone who's lived in England, spent any time in England, you will have heard about 1966 because it was the last time the male football team won anything at all.
Honestly, I love that that's where your mind goes. I just love that we're coming up with these sizes and scopes. The first 4-day losing streak since 1966. And, of course, you go
to end a year.
To England. Well, it speaks to sort of Santa Claus rally that just didn't happen, and the fact that people tend to feel good. And this year they didn't feel good. And why not?
If you're a Brit and you see that year, 66, World Cup win. 1966.
It's like 86 for the New York
If
Times.
you're Scottish, of course, you're deeply unhappy about that, or maybe you're happy that it's been so long. If you're English, depressed, I don't know.
This wasn't on my bingo card for
there
today.
You go, so you've learned something. I mean, Manus took us there.
Thank you, Manus.
Manus took us there, and then he wandered out loud whether it was 66, so just providing some confirmation.
Thank you, I appreciate
Let's get some serious stories. Out of surveillance this morning. Federal law enforcement is examining whether there's any link between a pedestrian attack in New Orleans and a Tesla Cybertruck explosion in Las Vegas, both occurring, Lisa, on New Year's Day.
And one of the connections here, aside from just a potential suspected terrorist attack in both locations, is that both cars were rented through a car-sharing website, Turo, which I've actually used before. And I was wondering, what this potentially could mean. And you just start wondering, okay, is this something from an outside external actor because the suspect in the New Orleans attack was a U.S. citizen? What does this mean in terms of other potential threats, especially ahead of the inauguration?
The kind of threats that law enforcement have been warning about and incredibly worried about, which is why some football games have had to be pushed back because of this.
Yeah, the Sugar Bowl, that was postponed until today at a time when New Orleans was trying to upgrade some of their protections around the streets, but it hasn't been implemented yet. So there's sort of these questions around how do you fortify a number of regions, and my mind goes immediately to Washington, D.C. ahead of the January 20th inauguration.
Yeah, for good reason. Incoming information, still incoming, of course, and when we get more headlines, we'll bring them to you in about 10 minutes' time. South Korean police searching offices and the airport where Sunday's fatal Jeju air crash happened. Separate investigations are being led by Korea's Transport Ministry in collaboration with US officials and with Boeing. Just a tragic incident over the holidays.
So essentially, there were some thoughts that maybe this could have been a bird strike that took out an engine or both engines over the Jeju airport. A real question here around why there wasn't further deployment of some of the sort of speed-reducing mechanisms that planes normally have. Still so many questions. Just such a tragedy. One of the worst, most fatal accidents you can imagine at a time where South Korea is already struggling with a whole host of issues having to do with leadership and having to do with just what kind of security oversight they have.
The team in Bloomberg News were writing about this over the holidays. Not a great year for the aviation industry through 2024. This, of course, not the only incident.
Yeah, although, just to be very clear, it does not seem like this is a Boeing issue. And
Sure.
so this is, and the reason why I say that is because that was one of the first questions that people had, because essentially there was a question about Boeing issues, Airbus issues with the engine. This doesn't seem to be that, but you're right. And how much is this just a hangover from the pandemic and a lack of some of the personnel that were deployed?
That company had a pretty awful 2024. That's for sure. Let's turn to this story. Japan's Nippon Steel is making a last-ditch appeal to win approval for its takeover of US Steel. Sources now telling us here at Bloomberg the Nippon is offering veto power to the United States government over any reduction in US Steel's production capacity. Is that enough to finally get this over the line?
You know, one question that I have about this is, do they think that President Biden is more likely to sign off on this deal than President-elect Donald Trump? Is that why they're moving to these last-ditch efforts now, before January 7th, when President Biden has to either sign off or not? And that ultimately is a key question at a time where this is something the board wants and something the union has pushed away from.
We've said this a few times over the last few months, the deal that just will not go away, and there's a new sweetener. We'll see what happens. Let's turn to energy. Russia holding its gas deliveries to Ukraine after a transit deal between the two countries expired after 5 decades. The move sending gas prices higher and keeping traders on the watch for faster withdrawals from storage inventories. Bloomberg's Will Kennedy joins us now for more. Well, welcome to the programme, sir, and Happy New Year. Walk us through where this leaves Europe, not just Ukraine, where it leaves the continent in the months and years ahead.
Happy New Year, John, and thank you for having me on. Yes, it is 5 years, so 50 years of these exports through Ukraine. So it's a big moment in the history of European energy. But right now it had been only supplying about 5% of Europe's gas. So it's not hugely material, but it is significant. It's significant mostly for the countries that relied still on Russian gas, principally Slovakia and Hungary, and to some extent Austria. But it also means that that gas will have to be replaced principally through LNG imports from the US and elsewhere. And it will just serve to further tighten the European gas market. Prices already at the highest after this news in more than a year. And while they're some way off the huge spike we saw in the aftermath of the invasion, they are painful and add to this sense that energy costs are a drag on the struggling European economy.
Well, Lisa was talking about this earlier on in the programme. Looking at your work that you and the team have been doing, it doesn't look like Europe's in imminent danger of running out of fuel this winter, but there could be difficulty restocking stockpiles. Can you walk us through how difficult that might be?
Yeah, I mean, the background here is that stockpiles have been falling faster this winter than in the previous 5 winters, and that's partly driven by this news, but partly driven by colder weather. And this cut-off that we're seeing through Ukraine is happening at a time when we're going to get some very cold weather across Europe, in Eastern Europe and Northern Europe, and that will force people to draw on gas inventories, stockpiles, and will tighten the market still further. So in the short term, we have this twin effect of supply being constrained by the decision to cut off this gas and demand being fueled by cold weather. And it does mean an overall tightening in the balances for Europe.
Well, since 2021, when this Russian oil accounted for about 40% of the imports to Europe, there has been a huge diversification effort in Europe, particularly with Qatar, as well as the United States. Do we have a sense of how much capacity can be ramped up and what the willingness is from both the U.S. and Qatar in terms of increasing some of the exports to Europe if this were to happen with respect to some sort of cold surge?
Yeah, so we see both in America and Qatar, and you're right to identify, Lisa, those are the main sources that Europe can turn to for LNG imports. They are both adding supply capacity. We're seeing new projects getting built and come online in the US, notwithstanding the Biden moratorium on new projects being approved. And Qatar has a plan to expand its capacity at its giant gas field. So that will be available in the years ahead. But of course, the thing about LNG is it competes in a global market, and there are other people who rely on LNG, especially in East Asia. So it does create vulnerabilities, it does create volatilities, and it does create new political uncertainties. We've already seen Donald Trump perhaps pegging trade relationships with Europe on their willingness to import more US gas, so that becomes part of the equation.
How quickly could that be ramped up, Will? A lot of people have been talking about, as John mentioned earlier, this is basically pushing on a door that's being opened real wide by Europeans in terms of buying more liquefied natural gas from the United States. How quickly could that go into effect?
Well, some of that gas is coming because we're seeing new long-planned facilities reach completion and being opened, but it takes many years to build an LNG plant. So while we can see that there's more gas coming and that there will be more capacity in the years ahead, any huge upward, further acceleration of that will take years to come. Now, I think the global market probably can supply Europe with the gas it needs, but I think when you look at the balances in the years ahead, we're likely to see a global gas market that remains relatively tight, and that most of that LNG we can see will be demanded in Europe and elsewhere. So this period that Europe's had of relatively high gas prices and hence energy prices may not come to an end at any time soon.
Well, does this undermine the effort across the continent, including the UK where you are, to transition to renewable fuels and away from fossil fuels?
Does it undermine it? I think it's under a lot of scrutiny because clearly there's a lot of talk about the investment required to make the transition, but it's a double-edged sword, John, because on one hand, yes, it is expensive and it is placing a burden on European bill payers, households, at a time when they're having to pay more for existing gas. They're always having to invest in windmills and solar panels. But on the other hand, a lot of policymakers would say investment in renewables is essential to ensure the continent's energy security, and that, as you see, the Russian crisis has shown the dangers of being reliant on imports. So if you can generate electricity at home using wind and solar panel, that does increase your energy security. So I think it's a very live debate, as you say, but there are arguments and proponents on both sides at the moment.
The European consumer's paying up for it, that's for sure. Will, appreciate your time, sir. Out of London, Will Kennedy there of Bloomberg. Just compare and contrast what they're paying for energy compared to the US, night and day.
Yeah, which raises this question, and Will was right to point out that the idea of energy independence looks very different in a land that doesn't have as much oil. I think you raise a great point, though, of how the conversation has shifted around fossil fuels, especially at a time where there's a focus on artificial intelligence and how much you can power that. And now the focus really has gone to sucking carbon out of the air because, oh yeah, it's not going to be so easy to really slow this down given some of the energy demands.
That's the latest out of Europe, with an update on stories elsewhere, including the latest in New Orleans and beyond. Let's get you the Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. And we start right there. At least 15 people were killed in a deadly attack in New Orleans' French Quarter very early on New Year's Day. The FBI is investigating the attack, which involved a pickup truck and improvised explosive devices. The FBI is also looking into possible connections to terrorist groups and whether the suspect acted alone. The suspect, a U.S. Army veteran, was killed at the scene. And another deadly incident in Las Vegas yesterday. A Tesla Cybertruck exploded outside the Trump Hotel. Tesla CEO Elon Musk said it was probably an act of terrorism. The driver was killed and 7 people suffered minor injuries. President Biden says officials are investigating whether there is any possible connection to the attack in New Orleans. Elsewhere, the U.S. Dock Workers Union and employers are expected to resume contract talks on January 7th. If there's not a resolution, a strike would occur on January 15th, shuttering major ports on the U.S. East and Gulf coasts. The main issue is whether employers can add semi-automated machines to port terminals, which the union sees as a threat to jobs. And that's your brief, John.
Danny, thank you. That deadline, of course, on CPI Day which is important. It's another event risk for the path forward.
Yeah, at a time when this used to be one of the biggest risks that people had, that could potentially be yet another supply disruption that could increase some potential costs.
Quite a stacked month to kick off 2025. Up next on the programme, higher for a whole lot longer.
Ultimately, I say it all the time that the most important number in the world is what that 10-year yield is being priced at. I think that we start to really be concerned if we get another 50 basis points of term premium making its way in the market.
That conversation up next, live from New York. This is Bloomberg. Bouncing back from 4 days of losses on the S&P 500, we're higher by 0.8% in the bond market. Yields are down by 5 basis points now. The 10-year at 4.52. And look out below if you are the euro. Euro dollar 103.23. The low of the session 103.14. And already the weakest level for the euro going back to November 22. It's brutal out there for the Europeans.
And it's two-sided. Upside surprises from the United States at the same time that you get downside surprises from Europe. It's not a good mix.
More rate cuts still to come from the ECB, and a real conversation emerging at the back end of last year about whether this Federal Reserve may even need to hike interest rates over the next 12 months. Under surveillance this morning, higher for longer.
Ultimately, I say it all the time that the most important number in the world is what that 10-year yield is being priced at. And really kind of the movement that you laid out over the course of the last couple of weeks is saying that there's a lot of uncertainty about that very, very important number. I think that we start to really be concerned if we get another 50 basis points of term premium making its way in the market.
So here's the latest this morning. The US Treasury market holding steady after yields closed out 2024 with the biggest annual gain since 2022. Earl Davis of BMO joins us now for more. Earl, with yields lower on the session by 5 basis points at 4.51. First of all, sir, Happy New Year and welcome to the programme. There's a lot to consider for the next 12 months, and there was 3 points that you put down. Tariffs, increased bond supply, and a Powell showdown. Earl, of the conversations you've had with your clients, out of those three, what did you spend most time on?
Well, we definitely spend the most time on tariffs right now, but it's a big unknown. And we actually tell people tariffs right now is providing us with an opportunity to go longer fixed income. And the reason why that is all the talk about tariffs and the unknowns have increased yields to these levels to what we would deem relatively attractive levels, both on a treasury and a corporate space. So we've been using this as an opportunity to add to duration and add to credit.
So let's start with treasury and then we can move to credit. Is there a specific place on the treasury curve where you feel more comfortable doing that?
Yeah, we actually feel 10 years here adequately rewarded at around 4.5. This first quarter is going to be very telling for treasuries. And the reason why it is typically in the first quarter, what you get is real money accounts. And I'm talking about not hedge funds. I'm talking about large insurance funds, large pension plans. Typically, real money accounts in the first quarter reallocate their risk between, fixed income and riskier assets. Given the price action that we saw last year, we should be seeing a significant rotation into fixed income this first quarter. It's an unknown because of the inflation and tariffs as to whether that would happen, but we're putting our chips on the square that it will. So what that means is from these levels at 4.5 in 10-year yields, there's a better chance of seeing 4.25 than 4.75 in the first quarter of 2025.
Earl, how much is this driven by international accounts? We've been talking all morning about the euro and about the divergence between rates and real rates in the U.S. versus Europe. How much is that the real money that you expect to come back in and say on a relative basis, I'd rather put my money in treasuries?
The interesting thing is in the analysis I just gave you into the first quarter, I didn't even take into account international. Now you add in international, which does have an increasing appetite for U.S. assets. That bodes well for all U.S. assets, including fixed income. So that's another argument why we believe, at least in the first quarter, it will be higher for longer, but we think there's a better chance of seeing 4.25 and 4.75. I'll add in one more reason as to why we're overweight duration in 10-year U.S. treasuries and tips at these levels is that we expect tax receipts to be, pretty good, which means the refunding announcement or the amount of treasuries to be issued in the first quarter and first half of this year could surprise to the downside.
Normally, when you have a rally in treasuries, that's negative when it comes to risk assets. This time, though, you actually see it being positive for credit. And I'm curious about why, given the fact that typically when people pile into treasuries, it's a sign that the economy is slowing.
Well, you have to break down treasuries into two things. One is inflation and inflation expectation, and the other one is real rates. Those are the two drivers of treasury yields. Why we think this could be good for both risk assets and fixed income, the reason why we rally to 425, where we see that, we believe 10-year tips, which is the real rate, which is approximately 220 now, could easily go down to 2% and 190. And the reason why we say easily is if you're an international investor looking to invest in the US and you could get 220 basis points over inflation for the balance of your holdings, 10-year tips, that's where you go. So we think the tip rally is going to be the driver of lower yields, which is also beneficial for risk assets because it reduces your discount rate on your cash flows.
Can we just sit on credit just for a bit longer? In equities, we spent a lot of time over the last month talking about negative breadth, the underperformance we'd seen beneath the surface of the market, what we're seeing on the small caps, terrible month in December after a great November. Did you see any confirmation of weakness in high yield at all? Any reason for concern?
I wouldn't say confirmation of weakness. We have seen high yield spreads widen, and that just came off of let's call it profit taking in December. But we do believe the environment, the context in which the economy is set up for in 2025 under Trump presidency is beneficial for small, medium, and larger size companies, the deregulation. So what that means for us is a lower chance of probability of default in 2025. When we see lower chance of probability of default in 2025, that makes high yield more attractive because we say we're getting, even though it's tight credit spreads, we're still getting rewarded, especially on an all-in yield, for the risk that we're taking. So we're actually looking for opportunities to increase our high yield exposure selectively with selective names, as an active manager does.
Earl, good to see you, as always. Happy New Year. Earl Davis there of BMO. Let's pick up on the thoughts of the credit market because they are important. We've heard this a few times. Spreads are tight, even with the recent widening over the past month or so. We're still south of 300 basis points at high yield. But how many times have people come on the programme and said, yes, spreads are tight, but all-in yields, pretty decent, and we want it?
Yeah, which is the reason why people are buying. Just to put this in perspective, CCC rated corporate bonds, this is the lowest rated tier of bonds, returned more than 15% last year. That was second only behind the S&P 500 when you start looking at returns. This has been an incredible year, but you're right. The all-in yield looks enticing at a time where some people argue the actual quality of the debt has gone up. The companies are doing okay. They've pushed out their maturity wall, and private credit has taken off some of the risk as well.
That's credit, then treasuries. More likely to see 425 than 475. We're going to start the year with some buying. We're starting the year with some buying. Yields are down 5 basis points on 10s. Early days, granted, but this is the argument coming from BMO.
Yeah, when you take a look at real yields right now in 10-year treasuries, when you strip out some of the inflation expectations, it's around 2.23%. That is really off the high of 2.5% reached in the past couple of years, but it's creeping up toward that high level. Some people are saying on a real basis, this looks good, especially international money, especially funds that are questioning some of the policy sequencing in the United States and risk assets.
Bond yields lower across the curve this morning. I can't believe we're back. Where did the holidays go? 2025? The third hour of Bloomberg Surveillance up next. Here's the lineup. Stuart Kaiser of Citi, Oliver Chen of TD Cowen, Aditya Bhave of Bank of America, Troy Gayeski of FS Investments. The next hour, just around the corner.
The bull cases have gone away.
There's quite a lot of momentum still to be had, particularly in the first half of next year.
What tends to happen, though, in January is all the sort of market moves that we have in December get completely unwound.
As the market broadens out, what that means is that the former winners are going to start to decline a bit.
I'm not really sure if markets really know what to expect. I think that creates some volatility.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance starts right now. Let's kick it off with the price action, with equity futures bouncing back from a 4-day losing streak on the S&P 500. We are higher across the board here. On the S&P 500, up by 0.8%. On the Nasdaq, up by a little more than 1%. Similar move on the Russell after a terrible December for the small caps, down by more than 8%. The road ahead, the month ahead, looks a little something like this. On January 10th, we get payrolls. On the 15th, CPI. On the 20th, Inauguration Day. And a week after that, we'll hear from the Federal Reserve.
And this really comes down to how much can economic data overwhelm the vacuum that is what sort of Donald Trump's policy will look like in the road ahead. January 20th is really when a lot of people see the year starting, when you can understand where the priorities go. Until then, though, do we continue to see the momentum that really has supported equities to that biggest 2-year gain on the S&P 500 going back to 1998?
I think straight out of the gate, we're expecting some executive action from the incoming president of the United States. Tariffs are going to be a big focus. The appetite for debt, another big one for the Republican Party. Speaker of the House, still unknown. I imagine it's going to be Johnson. The president thinks it's going to be Johnson. The guests think it's going to be Johnson. But we've seen some infighting in the Republican Party already. Where are the policy priorities to kick off 2025?
And how much is this the reason why we saw that sell-off in rates? And when you talk about the underperformance of the Russell 2000, it stems directly from a backing away from U.S. government debt with this concern that maybe some of these policy prescriptions are going to be a bit, I don't want to say toxic fruit, but a bit of a sort of headwind. That sounds a lot more sanitized.
It's very constructive for Bramo,
Well, I mean, honestly, it's hard to get too sort of against everybody because the groundswell seems to be for U.S. everything and buy everything, and everyone's happy. No one's bearish on the U.S. So, you know, I think that I have to
good.
sort of...
Confidence is high for consumers and businesses alike. We'll see what we get, but I agree with you. It's not clear what we will actually get from the incoming administration.
And whether you can have your cake and eat it too. A lot of people are talking about how big tech can keep driving U.S. equity performance, even though you do have higher neutral rates and you do have some signs that maybe the optimism has been overplayed in markets. And that is the mix that kind of feels a little bit like tension right now that needs to break one way or the other.
Well, we're breaking to the upside this morning. We're up by 1% on the Nasdaq 100. Big move on the S&P 500, bouncing back on the small caps. The Russell down by more than 8% in December. Back to back. November, best month of the year for the small caps. December, worst month of the year for the small caps. Just absolutely whipsawed in equity markets over the past 2 months. Coming up this hour, we'll catch up with Stuart Kaiser of Citi as the S&P 500 notches its second consecutive yearly gain of over 20%. Oliver Chen of TD Cowen on the retail outlook for 2025. And Aditya Bhave of Bank of America on this morning's jobs data. Jobless claims just 26 minutes away. We'll begin this hour with stocks higher, looking to snap a multi-day losing streak as the S&P 500 clinched its best 2-year run since 1998, boosted by AI enthusiasm and some Fed rate cuts along the way. Stuart Kaiser of Citi looking ahead. We continue to like large cap tech, quality and growth given the higher for longer nature of the FOMC. Payrolls on January 10th are a major catalyst given last month's data, the SCP update and markets pricing just 2 cuts in 25 and a 10% chance of a 25 basis point rate cut in January. Stuart joins us now for more. Stuart, good morning.
Good morning. How are you?
Happy New Year. It's good to see you, sir. Let's talk about how different the setup is this time around compared to 12 months ago. Pricing in 1 or 2 rate cuts, whereas last year we very quickly started to price 6 or 7. How different are things this time around?
I think it's a lot different. I mean, last year was a second consecutive year of we're going into recession and we're going to a recession immediately. So it's probably the first year in 2 or 3 years where recession hasn't been probably the top line item on the economics front, which means now we're probably going to get it. But yes, I think that's the big difference. I think the other part is the nature of the buying. You talked about small cap underperforming. I think a lot of what we saw in December is, frankly, the buying was coming through foreign investors and ETFs. And if you're a foreigner buying U.S. equity markets, you're coming to U.S. equity markets because we have large cap tech growth stocks, right? So I think that foreign flow tends to gravitate into that part of the market, and that's probably why you saw the big differential in returns.
Do you need that pool, that reservoir, so-called reservoir of negativity to feed on? Do you need it this time around? And can you find it abroad? Is that sufficient just to say that things are so bad elsewhere, it'll keep feeding gains in America?
I think that is a fair point, actually. We talked to a lot of investors who are short or underweight Europe, are concerned with how consensus that positioning has gotten, but also say, what else am I going to be short or underweight? So there is a little bit of that bit of it. There's really not a whole lot of other options to put your money in. I think people are relatively bullish on India, probably. Japan is probably still a positive trade. You've got a lot of uncertainty in Korea. You've got a lot of uncertainty in China. You have Europe doing what Europe does. And I think that just makes the U.S. look better on a relative basis. So I do think that's an important aspect of it.
Is the concentration in U.S. equities of big tech a benefit or a detraction to the investments into the U.S.?
I think it's a good question. I'm a little less concerned about concentration. I mean, I think those companies are performing well for a reason, and that reason is they're large cap, really safe credit, generating a lot of earnings growth, have a lot of thematics behind them. So I don't necessarily think that concentration is such a negative thing. As I mentioned, I do think there's a feedback there. I think international money coming into the U.S. is coming here specifically for that. So it kind of feeds on itself, if that makes sense. So I don't necessarily, think it's a negative. I think there is a really big hurdle right now to investing outside the U.S. You'll talk to EM investors and say, what part of EM would you own? And I'll say U.S. small cap, right? Like you can kind of find that those risk profiles within U.S. equity markets. So it's kind of like the money has come here and it's almost gotten trapped, and it doesn't go back out. It just kind of moves around within U.S. markets.
If you are the executive of a small cap and would like to write some hate mail, please feel free to write in after being called an emerging market exposure in the United States. I do wonder what the relationship is with U.S. rates. And we've been asking all morning this question of, are rates cheap or are stocks expensive? And it feels like that tension was at play at the end of December. How much do you expect that to be the main driver of the dynamic to start this year?
I think it's really important. And I think it's a question of which part of the yield curve do you focus on and what are you most concerned about? If you're a U.S. equity investor sitting here, are you more worried that 10s go to 5%, or are you more worried that 10s have a 3 handle on them? And I think you could argue, if you're a U.S. equity investor, that 3 handle is worse news, because that 3 handle means your growth data has really disappointed. You're not getting back down to 3 unless the unemployment rate starts to rise, right? Whereas I can paint a positive story for you of U.S. economic growth surprises to the upside, you have a Trump growth impulse, and that pushes the 10-year up to 5. So you could argue that actually a lower 10-year right now might be a bigger risk from a recession point of view. In terms of the curve, we're most worried about higher yields at the really long end. So the 30-year is the part of the curve I think we'd be most concerned if it dislocated to the upside. And the logic there would be, paint me a picture of why the 30-year gets to 5.5. And the data that it would take to get the 30-year to those levels, it's hard to find a positive spin to get you there. So, yeah, I think the rates markets are incredibly important. It's hard to make a call either way. And I think these questions are the questions investors, I think, are asking right now is which direction is worse for me and what is the sequencing of data that would get me there?
So Max Kettner of HSBC has made the call. He thinks we are in the so-called danger zone for 10-year rates of about 450, which disrupts risk assets. Some evidence of that over the last week. I think credit to you. You've been pretty consistent about this for the last 12 months. So long as the labour market holds up, you should be buying US equities. Is there any reason to change your mind on that front going into 25?
I mean, we'll see January 10th, I guess, would be my quick and flippant answer to it. But look, I think the Fed has told you right now the unemployment rate is probably the single most important data point that they're following and that you're going to get every month. So if that number stays low and they're forecasting it's going to flatten out, which I think is a very, very bullish forecast for U.S. equities if that actually happens, then I think you can get 10-year yields higher with equity markets doing fine if that kind of sequencing of data comes out. So I do think it's the labor market. I think you need to focus on it. And, at one point it was average hourly earnings. Then it was we played around with payrolls and claims. I think right now it's actually the unemployment rate that's probably the single biggest data point we're going to get on the 10th.
So did we learn over 2024 essentially that this market is insensitive to rate hikes? That basically this is not one that responds given the fact that you continue to say, ultimately, that doesn't matter as much as the raw data. And if the raw data holds up, then guess what? It isn't that restrictive after all.
Well, yeah, because I think it's the why. I think, the inflation print we got on July 11th, I think it was, convinced the market that this inflation number is moving lower. And once you sort of took that upside tail out of inflation, then the hikes and cuts kind of became a little less important because it reoriented equity markets back to growth. So to your point, it's the raw data. If that growth data holds in, then yields moving a bit higher is, I don't want to say inconsequential, because it can matter, particularly if you get a fast move. But big picture speaking, if I'm an equity investor and that unemployment rate's 4.2%, it's hard for me to be negative U.S. equities in that environment.
What would it take for you to be positive on Chinese equities, given the fact that they just lost the most going back to 2016?
It would take quite a bit, I think, for us to be positive on it. Well, as a U.S. investor, look, our Asia guys are probably bullish on Chinese equities right now. The challenge I have is when we talk to investors in the U.S., the bar for them to reallocate into China is quite high. And I think if you remember back to October, November timeframe, they announced some packages, then we had that Golden Week holiday. And that holiday, I think, had raised expectations for after this holiday, they're going to come back with the bazooka. And they're going to announce all these policies that are going to keep this going. And frankly, they just didn't. It wasn't that they didn't announce anything, but they just didn't meet expectations. And every time you kind of don't meet expectations, people get more and more skeptical. So I think from a U.S. equity investor perspective, it's just very hard to justify going into China.
The reason why I ask this is because I'm struggling to find a contrarian right now. I'm struggling to find someone who pushes against the idea of U.S. exceptionalism and starts to find opportunities elsewhere, maybe on Europe on the margin. Some people are getting excited in a tactical level for China. And I'm just wondering how concerning that is to you. The contrarians seem to be dead. Bears have been beaten up. And there's this real question of how lopsided positioning actually is getting.
I mean, they're dead because we don't like what they were saying, right? So, look, I think, if you...
This is getting personal.
No, look, if you think of U.S. exceptionalism, though, what are the two biggest things that have driven U.S. exceptionalism the last couple of years? One is massive fiscal, that we were doing that the rest of the world wasn't. And two is we have large cap growth and tech stocks. So if you're thinking U.S. versus China, which of those is most likely to kind of reverse or go the other way? It's the fiscal. Right. So if this, continuing resolution was a shot across the bow, that fiscal is going to be a real issue. And it looks like the fiscal impulse, our U.S. economists have the fiscal impulse flat. And there's a lot of third parties that have that fiscal impulse quite negative. So if there is something that would get you into China relative to the U.S., I think it would be that the fiscal impulse reverses regionally between those two countries. But we are so far out of my area of expertise that I'm probably going to get a text right now from somebody that I should just shut up.
It's a good save, Stu. I'll give you that. It's a good save. Stuart Kaiser there, Citi. Stu, thank you. If those of you are interested in the performance of China overnight, the CSI 300 actually closing the session down by 2.9%. The Hang Seng in Hong Kong down by more than 2. Not a great start to 25.
Yeah, well, manufacturing data came out and it was pretty negative. And I was actually looking at how much the economy underperformed in 2024 in China, about how the losses tied to their property declines are greater than anything the U.S. experienced during the heart of the financial crisis in 2008 and 2009. It just raises a question. How much has this been baked in, and how much more does that have to go?
To give Stuart Kaiser some more credit, just to save you from the hole you dug in on China, just take a look at the chart. Compare a Chinese 10-year yield to a US 10-year yield, and tell me which chart you'd prefer. Where would you rather be? The one with yields climbing because of a better growth impulse, or the one with yields falling off a cliff? Because one's the United States, the other's China.
And people are voting, and they're voting for the United States. Stuart actually made a fantastic point, even though he did dig himself immediately into a hole, which is that ultimately it's a divergence in fiscal policy. The U.S. loosened the taps, and China has been reluctant to do so. Could that change? Unclear. In the speech that Xi Jinping gave for the new year, it didn't seem like there was a real embrace of that.
You're between friends, Stu. You're lucky. It's good to see you, mate. Happy New Year. Thank you, sir. Equity futures right now on the S&P up by 0.8% with an update on stories elsewhere. With your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. A tragic start to the new year in New Orleans. A driver rammed a pickup truck into a crowd in the French Quarter. The FBI is investigating the attack as an act of terrorism and said it doesn't think the driver was solely responsible. At least 15 people were killed and dozens were injured in the attack. The driver was a U.S. Army veteran and was killed in a firefight with the police. Meanwhile, in Las Vegas, a Tesla Cybertruck exploded outside the Trump Hotel. Elon Musk said that the explosion was probably an act of terrorism. The driver was killed and 7 people suffered minor injuries. In a series of posts on X, Musk said that the explosion was caused by fireworks or a bomb. President Biden says that officials are investigating whether there's a connection to the attack in New Orleans. South Korean police conducted raids on offices and at the airport where a plane crashed earlier this week, killing 179 people. The police investigation is aiming to uncover the cause of the country's deadliest aviation disaster and determine responsibility. The plane's data recorder, which monitors key flight information, will be sent to the U.S. for repair and analysis. And that's your brief. John.
Hey, Danny, thank you. Appreciate it. More from Danny again in about 30 minutes' time. Up next on the programme, the morning calls, plus Oliver Chen of TD Cowen on what's ahead for retail in the new year. That's just around the corner. This is Bloomberg. Here's the bounce the summer you were looking for. We're higher by 0.8% on the S&P. The bond market rallying in two. Yields are lower across the curve, including on a 10-year tenor. We're down by 4 or 5 basis points. The 10-year yield is 452.28. Let's get you some morning calls. First up, JMP Securities downgrading Alphabet to market perform, citing the possible impact of antitrust penalties on Google's revenue streams. That stock still higher, in line with the market, up by something like 1% in early trading. Your second call from Deutsche Bank downgrading Lockheed Martin to hold, saying China competition may undermine demand for its aircrafts. That stock is down just a touch in the pre-market. We're negative by 0.14%. And finally, Bank of America reiterating Nvidia at its top pick, citing the Consumer Electronics Show as a positive catalyst. That stock is up by 1.5% on the morning so far. Let's turn to retail. Oliver Chen of TD Cowen cautiously optimistic heading into the new year, calling for, quote, very slight improvement and stabilization in China, green shoots of an aspirational customer spending more this holiday season, and new product introductions in opening price points. Oliver joins us now for more. Oliver, welcome to the show, sir, and Happy New Year to you. I want to talk about luxury and why you think we need to get beyond boring, quiet luxury. Oliver, who's doing that right now?
Yeah, John, the name we like is Louis Vuitton. We think that's a great idea in terms of the scale they offer, as well as this 21 times PE and the rising middle class in China. So there's a nice long-term opportunity, and they're spending $8 to $9 billion on marketing. What's been happening in luxury is the big has been getting bigger. That being said, as you know, China's been a tougher place, particularly with housing. So it's something we're watching. Quiet luxury has been a big trend. However, what we do want to see is more fashion, more color. Louis Vuitton has a new collection out in the new year, the Murakami collection. That will be a nice thing to see, too, as consumers are yearning for more fashion, more style. However, there's cross currents here with the lower and middle class under more pressure, too, with inflation still, like the consumers feeling that as well.
Let's talk about how trends are shifting, though, Ollie, and let's go back to, say, the 1990s. It was a phrase I always hated, but heroin chic, led by the likes of Kate Moss. And then Giselle arrived in the late 90s, the early 2000s, and you saw this big shift. Are we witnessing that kind of shift right now in luxury?
Yeah, John, what we're seeing is Y2K, going back to the 90s, references to Paris Hilton and others. So nostalgia has been a big deal. And that's a trend that should continue, in part because when you look back to go forward, consumers like the comfort to a certain extent of nostalgia and what that has to offer too. So mixed trends in terms of what you're saying, and a lot is working, but nothing very dominant. So you're seeing silhouettes work across many kinds of jeans, high rise, low rise, as well as skinny and wide leg. But what you're saying is quite true in terms of fashion being pretty eclectic. We're also looking at a lot of basics. Consumers are looking for value, personalization with a twist. That's what we're seeing too.
I'm still trying to get over heroin chic. That was an era. I hope that we're done with it.
Yeah, I'm uncomfortable with the phrase anyway, sort of glamorizing something pretty toxic, pretty negative.
Yeah, and it was really kind of sickly and skinny, and that was sort of the trend. And
then Hot made a comeback. Remember, Giselle was known as the body.
Yeah, actually somebody...
I'm bringing this up for obvious reasons. Are we leaving woke behind? And so-called body positivity, whether that was actually a positive body image is something we can debate another time, and replacing it with something else.
Well, and we've seen this with Victoria's Secret, but there's this larger question, Oliver. I'd love you to weigh in, not necessarily on heroin chic and what exactly hot making a comeback and other things that we've talked about that I'm sure you want to stay far clear of. I am curious about whether a lot of what you're seeing and a lack of a trend is driven by the TikTokification, the idea of social media selling, the idea of influencers, and how quickly that can move in a new way that's really challenged a lot of the legacy brands.
Yeah, Lisa, definitely. TikTokification is a big deal in terms of what's happening with short form video. What that's really driving is ultra fast fashion in terms of trends coming and going quickly, as well as a myriad of trends. The industry performs a little better when there's one dominant trend, but there's been decentralization as a theme. And so we'll continue to see that. The bottom line for retailers is that they need to get a lot faster in terms of supply chain. Also, this integration of technology meets value. Walmart was a top idea for 2024. It's a value offering as well as offering discretionary product. We like BJ's as well, and we like Costco. So The consumer will continue to look for value, and then we're selective in luxury. In the luxury arena, we like LVMH the most. And you do see wealthier customers buy from Walmart as well and shop at Costco. That's a trend to watch as well.
So I am wondering, just to go back to the idea of quiet fashion dying and the idea that that's personally offensive to Jonathan Ferro, I am curious from your perspective about what's driving that. Is that basically trying to cater, because usually in the past it was to cater in particular to Chinese retailers, to Chinese consumers. Is there something else that's making a comeback that you think benefits certain companies that you just mentioned?
Yeah, Lisa, what will continue to happen is this idea of timelessness and consumers looking for value. That's actually happening in jewelry, selectively in watches. Also at the high end, there's stocks like Hermes and Brunello Cucinelli, which are executing pretty well with timeless goods. And as you think about what timeless means, you're offering products that will age very well and you'll be able to use for a long, long time. So that trend is certainly working. And then beauty, skincare, fragrances, that's a market that continues to be vibrant. Going through some bumps now. We like a stock called ELF Beauty. They do a great job on TikTok. Plus they offer a very compelling skincare and cosmetics product as well. So that's something to watch. We're on the sidelines of names like Ulta and Target, and we're really hoping for interest rates to abate as well as the consumer to get more confident, because the consumer continues to be pretty choiceful about how they choose to spend. So it's something we're watching in terms of hopefully that discretionary dynamic becomes stronger going forward.
Just one final one. Oliver, just on China, where are you seeing signs of a bottoming out? Where are those green shoots coming from? Who's winning? Who's turning it around?
Well, I'd go back to Louis Vuitton. We think they're well positioned in terms of awareness, and they're executing really well. Stocks we don't cover include Hermes, where the momentum has been very strong with those wait lists for Birkin bags, as well as really executing at the very highest pinnacle of luxury. But our top idea is Louis Vuitton in terms of what we're seeing in China and the option value there as well.
Got it. We'll have a conversation about Gucci next time. Oliver, appreciate it, sir.
Yeah,
Oliver
sure.
Chen of TD Cowen. Not everyone can be a Brunello, a Loro Piana, an Hermes.
That's true.
Which has been Gucci's problem. They're trying to go into quiet luxury, and this is the point that Oliver's making. That's going to be difficult.
Especially because they have a reputation of loud luxury, or the opposite. The cosmetics thing. Can we talk about that?
Yeah, please.
I honestly am wondering at what point people start to push back against that. I mean, we did see a little bit of a hiccup, but the beauty products being the hot spot, we saw teenage girls really going into that and preteens. I just wonder how long that really is going to be the leader, with Sephora's and the likes kind of leading the charge.
Had a few interesting conversations on this front, haven't we? Heroin chic, Hop's back.
Well, I just wonder. I always wonder, if a cream costs $300, does it really do anything that special to your skin?
I assume it does something.
Does it?
Is that how much they are? Is that how much the creams are?
Sometimes if you take a look at the ounces, I mean, no, not 3,000. I said 300.
Magic for $3,000.
I know, exactly. You better transform this thing.
Transformation. Jobless claims data seconds away, about 20 seconds away. I'll share the estimate with you. That is 221K the previous week. The number was 219. Going into it, equities are elevated, up by 0.75% on the S&P, on the Nasdaq 100, up by 0.9. So this is the bounce back from 4 days of losses to close out 24 on the S&P 500. In the bond market all morning to start the session to kick off 2025, we've had a bit of a rally across the curve. Yields down on 2s, on 10s. We're lower by 4 basis points on 30s at 4.74. Claims just drop, and they do drop. It's a downside surprise. It's the right kind of downside surprise. Jobless claims come in at 211 against an estimate of 221. Yields still lower across the curve here, Bramo, but that is an exceptionally low jobless claims print.
And when you take a look at continuing claims, they also come in below expectations of 1.84 million. That is down from the prior month. The revisions are lower when it comes to continuing claims, pretty much in line in terms of the prior week when it comes to just the weekly data. Again, this comes down to the question of how much of a head fake was that weaker than expected blip in terms of jobs figures. Do we have a sense that the U.S. economy economy is actually very stable without that weakness necessarily in the labor market that certainly the Federal Reserve used to be concerned about.
Looking ahead to payrolls for next week, so not tomorrow, it will be next Friday on January 10th. The estimate in our survey so far, 153. The previous month, 227. Off the back of the jobless claims number we just got moments ago, it came in at 211, the estimate 221. Equities still higher on the session, but just off session highs. We're up by 0.7%. In the bond market, we give up some of that bid. Yields were lower by 4 or 5 basis points, now down by just about 3 at 453.48. And as for euro dollar, near session lows, 103.15. The low of the session just moments ago, 103.12. Numbers we haven't talked about for a couple of years.
This isn't in isolation, and I think it's important to mention that. We got JOLTS data, job openings data, before we went off for break, and it came in significantly above expectations, with the job openings per unemployed American actually now even more than it was pre-pandemic still. So there's this real question about how much this really is a resilient labor market where any signs of weakness have been people trying to pick out little points rather than an actual trend.
To talk about the outlook and the trend we're on at the moment, Anna Wong of Bloomberg Economics joins us now for more. Anna, welcome to the programme. We saw a bit of an employment head fake earlier last year. We saw it in Q3. There was a real worry about a break in the labour market. Anna, how much of a head fake was that? And how much continued weakness did you see beneath the surface to close out 2024?
Yeah, I think I wouldn't consider that a head fake. I actually think the improvement in Q4 was the head fake. So I would take different signals from initial claims and continuing claims. The initial claims is suggesting that layoffs is low, and indeed over the holiday period we have seen that some of the layoff announced, for example, by Stellantis, the automaker, has been canceled. So that's suggesting that that part of labor market is doing fine. If you have a job, you seem to be doing fine. But the continuing claims, well, the average duration of the average unemployed person is actually 23.7 weeks, which is exactly at about where the average maximum duration of unemployment benefits is. This suggests that if the initial claims continue at this level, the continuing claims would peak currently or in a couple months. That said, that is not a signal for unemployment, because in this business cycle, which is a very unique one, we have seen unemployed numbers trending up even though continuing claims is falling. And the reason that it will be peaking right now is because that people have maxed out their benefits.
Anna, just quickly here, I'm curious why you say that the head fake was some of the positivity that we've seen in the labor market data rather than the negativity that we saw a couple of months ago.
Yeah, so we drilled into the micro data that produced the unemployment rate, and we noticed that particularly the fall in unemployment rate in September was due to a surge in government hiring driven by election-related states. And this seems to happen in major presidential election years in the past. And typically what you would see is that this surge in government hiring will reverse in December to January. And we noticed that this reversal is already entrained in the November micro data, that the government hiring has slowed down already.
Anna, I appreciate your take. Anna Wong there of Bloomberg with a different take on the labour market data, calling some of the strength maybe the head fake and the weakness maybe reason for concern. This morning, not much sense of weakness. Not much of that at all. At 211 on jobless claims, Lisa, against an estimate of 221. That's an exceptionally low jobless claims figure in the United States of America.
At a time when people were expecting it to actually be climbing and that things had already bottomed out, basically at the lows that we've seen in terms of averages going back to pre-pandemic. A real question here, to Anna Wong's point, how much this data has been distorted. We continue to hear that. The messiness of some of the information we're getting. She pointed to some distortions with respect to government hiring around the election. We've heard about distortions around the hurricane. Are we going to now get distortions around front loading ahead of tariffs when you have basically stockpiling at companies? How do you get a clean read on an economy that's been anything but clear?
Let's try and get one now. Aditya Bhave of Bank of America joins us now for more. Aditya, good morning.
Thanks for having me.
Happy New Year. Fantastic to see you, sir. Which one was the head fake? The strength or the weakness? Weigh in, please.
Look, I think the question for the Fed and for the broader economy is that in a downturn, the labor market does not deteriorate linearly. It deteriorates non-linearly. right? And so we are seeing some signs of softness in the labor market, but it's been very gradual. And as long as it remains gradual, I think we can feel pretty confident that we're going to avoid a downturn. And better yet, if we actually flatten out, if the unemployment rate flattens out at 4.2, 4.3, then I think the Fed's going to feel very, very confident about the labor market, and it might be difficult for them to cut any further.
You say some signs of weakness, so let's start there. Where are you seeing those signs? Where are they now?
Well, the unemployment rate, for one, Powell said 4.2%, that's fine. Well, it was actually 4.246%, right? It was as close as you can be to rounding up to 4.3. So really, we moved up a tenth in the last month, in November. If we continue to move up, broadly, the unemployment rate has been ticking up, job growth has been moving down, and it's been pretty narrow. So as long as those trends continue, you at least want to keep an eye on the labor market. That's really the only point of concern right now about the U.S. economy.
I guess I'm trying to square the idea that people are saying that companies are investing that much more because of the AI super cycle, that this sort of reshoring or nearshoring is also spurring new rounds of investments from corporations around the United States. And then this idea that people are worried about a labor market at a time when the economy doesn't have enough people to actually be deployed into all of these jobs. How do you understand that?
Well, it's a matter of sector by sector. Right, so there may be shortages in some sectors, but those sectors are not particularly large if you look at the overall labor market. So most of the US labor market, 5 out of 6 jobs are in services, and a lot of that is blue-collar services. Right, so if those sectors slow down, then any potential growth from AI-related jobs isn't really going to offset that. And anyway, those jobs are relatively, higher productivity, less labor intensive, so the boost to the labor market from those jobs isn't going to be as large.
And one of the big saving graces has been that in a lot of those services sectors, there's been labor hoarding, right? And that's been sort of one of the trends of last year, especially post-pandemic. Has that stopped, or is that ongoing?
We still think this is a low hire, low fire environment, right? That's exactly what we saw in what we're seeing in the claims data as well. So this is actually quite relevant for the upcoming jobs reports. Typically, you see significant temporary hiring, seasonal hiring in November and December, and then layoffs in January. To the extent that you don't get that sort of cycle this time around, you might see softer seasonally adjusted payrolls in November and December, and then stronger ones in January.
Let's go through the Federal Reserve and the month ahead. So on the 10th, we've got payrolls, the 15th CPI, and on the 29th, we've got a Federal Reserve decision, and most people believe they'll stay unchanged. What do you expect will happen, and what would change that story between now and then?
We have 2 more cuts for this year, and that's it. But the risks are very much that they do less than that rather than more. So in terms of this month, I think the bar for cutting in January is very, very high, right? You would need basically a disastrous jobs report in order for them to cut in January. March is possible, right? So what would it take to cut in March? I think it would be something like the unemployment rate continues to move up, as it has done in the last couple of months, and then inflation could benefit quite a lot on a year-over-year basis from base effects in January and Feb. So if those 2 factors work out, which we expect them to do to a certain extent, then you'll get another cut in March.
March, we get another set of forecasts.
Yes.
I want your thoughts on the previous round of forecasts, how much they've already been influenced by potential policy changes from the incoming administration, and whether the most important data point this month is January 20th and not the 10th or 15th.
So Powell said that some folks accounted for policy changes, some didn't say whether they did or they didn't, and some explicitly said that they didn't, right? And I actually take him on his word on this, because I don't think even under current policy, 2.5% on core PCE inflation is a crazy forecast. I think it's entirely reasonable. Right? So as I said earlier, you can get some base effects that are helpful in Jan and Feb. From a bottom-up basis, housing inflation should come down. But that's it, right? So here's an interesting fact. Core CPI inflation ex housing has actually increased in the last year. Right? So this idea that there's broad-based disinflation, yes, we're headed in the right direction, but it's actually very, very slow. So we actually have 2.8% for the end of this year on the core PCE. That, for us, accounts for potential policy changes, tariffs, fiscal policy. 2.5, you can probably get there even without policy.
This raises this question of how the Fed treats the recent rise that we've seen in longer end yields, given the fact that this does tighten the mortgage market, even as inflation in other areas does continue to creep up and housing inflation is no longer the issue. Does that basically serve as an indictment of the rate cuts so far? that essentially that has allowed longer-term inflation expectations to remain stickier and kind of run counter to the Fed's goals?
From our perspective, it kind of does, right? So we were surprised that they went 50 in September. We didn't think it was the right call, and we thought it was really interesting that the 10-year moved up. So the 10-year was actually higher after they did the 50 than when the markets were expecting 25. Right, so some of that you can say, okay, we priced out a policy error, but I think the other thing that's going on is that markets think the Fed has probably already done too much, and the Fed's coming around to that view as well, which is now why now the risks are that they might be done or they might be very close to being done.
Alita, it's something we talked about a few times to close out last year, that their easing bias, in the minds of many, contributed to the high yields at the long end.
Which is the reason why people were so alarmed by the 40 basis point move in just December alone. I'm looking right now at U.S. mortgage rates. They're climbing back up to 7%. They're at the highest level now going back to July. So you are seeing price disinflation on the margins in housing at the same time that there's now an inflation issue that's getting sticky in other areas. It shows which beast is it that the Fed wants to slay, and how do they do that with a market that's getting a little bit away from that?
Things are still super expensive. You need a mortgage to spend a night in a hotel in New York City. You've seen that, Torsten Slock.
$417 average rate.
Record in New York. Absolutely ridiculous.
We spent too much time talking about that at home.
Did you?
Yeah, it's sort of the average. So is that talking about, super luxury?
Of course,
and then these others, what would the median be? What do you get? What you get is a lot less than anywhere else in the whole world, especially in London. I am aware of that. But yeah, it's pretty crazy.
We'll get some more data for you. Aditya, it's good to see you, sir.
Thank you.
Aditya Bhave there, Bank of America. That stat, of course, came from Apollo's Torsten Slock. Torsten also said this, for those of you interested in markets. Recent inflation readings show signs that the decline in inflation has stalled. This is what Aditya was kind of giving a nod to. And there is a risk of re-acceleration. For investors, the risk of a repeat of 2022, where the 60-40 portfolio underperformed significantly. Joining us now is Troy Gayeski of FS Investments. Troy, welcome to the show, sir, and Happy New Year. I'd love your take on the risk for 2025, according to Apollo's Torsten Slock. Do you agree with that? A repeat of 22? What's the likelihood?
Well, first of all, again, Happy New Year. Good to see you and Lisa again. I think from Torsten's point of view, he's more accurate on the bond side than the equity side, and that when we look at asset classes going into this year, it's more than likely that the trend remains your friend in equities. We're not going to get the same amount of multiple expansion. There's certainly question marks about whether margins can expand to the same degree that's being priced in the S&P. But it's more than likely we have another reasonably strong year in equities. On the fixed income side, though, and I know we've talked about this a lot the last 6 to 9 months, we still see a lot of challenges, right? You have the sustained inflationary impact that you discussed. You have the fact that the Fed's already arguably cut too much, which is steepening up the yield curve. Then you have limitless supply. And by limitless, I mean, think about it. For the next 10 years, we're going to be issuing 7 to 7.5% of all the treasuries that have ever been issued in history that are held by the public. And it's really questionable who the buyers will be. So when we think of challenges to 60-40, we see a much bigger challenge on the fixed income side, with the acknowledgement that clearly if inflation picks back up, which we don't expect, by the way, dramatically, that could lead to multiple compression on the equity side.
Troy, why isn't that a challenge, though? Just alone, just to see high yields above 450, pushing 5%, why doesn't that constrain returns in, say, equities?
Yeah, well, so again, I think if you think of the reasons for why there should be less multiple expansion this year, despite the fact that we still have 4.7% more money supply, despite the fact that the flow or new supply of equities has remained negative for quite some time, as expected to, you have, as you know, in this cycle, the key driver of corrections has been higher yields in the back end of the curve, right? So that's clearly a risk. That being said, we had higher yields throughout last year, and we still had a record year in equities. So we hear the argument that higher yields can restrain equity gains and certainly cause corrections. But if you think of the forward outlook, particularly in growth stocks, the fundamentals are still very, very robust. So we'd expect another strong year, just not to the same extent of 2023 or 2024.
I hear so many people, and we actually were just speaking about this with Earl Davis of BMO earlier, about how we've had such a sell-off that yields actually look pretty good. And so you have real money coming back in. And yes, there's a lot of debt that's being sold. And yes, the fiscal sort of profligacy of the United States has been something that eventually could come back to roost. But there is this question of, we've had 4 straight years of yields rising. How are we going to get a fifth if that's the first time we've seen that happen since the 1980s and inflation is coming down?
How are we going to get a fifth? I think a lot of people said that coming into last year. How are we going to get a fourth? So I think looking at history can be informative at times. You compare market cycles. But I think when you look at the straight facts of the situation, we've only finally gotten a normally sloped yield curve, meaning 10-year yield is finally slightly higher than Fed funds. That's an abnormal situation, particularly when you have an economy that continues to be as robust as it is today. Remember, we are a service economy. We are no longer a manufacturing economy, which is, I think, the biggest confusing point. So if you think of yields, we're not saying that it's a 0% probability that the back end of the curve goes lower. You would just need a material slowdown in the U.S. economy, which doesn't look apparent. I mean, even if we get spending cuts for the government, you're still looking at two minimum of 2% real GDP growth, more like 2.5 to 3 next year. So saying it's we're not going to get a fifth year because we already had a fourth year is probably not the greatest analysis. That being said, again, if you go to where yields probably will settle over the next several years, you know, the Fed will gradually bring the front end lower, albeit at a slower pace. We've always thought, you know, a 10-year minus Fed funds at 2% makes a lot of sense from a value standpoint, because then you'll finally have rolled down the curve, much higher yields, lower duration risk. So until we get there, I just think you have to live with the fact that it's going to be a messy bond market for quite some time.
Troy, that was actually the highest sophistication I could possibly come up with in terms of 4 straight years of yields rising. How can we get a fifth? I do wonder, what's your top bet for 2025?
What's that again, Lisa?
What's your top bet for 2025? What's your highest conviction trade?
Yeah, so it depends on the strategy. I mean, we're really bulled up on middle market private equity. When you think of the landscape, you've had roughly 6 to 7 times the revenue growth of the Russell 2000 for the past several years. You have tremendous potential for being kind of a picks and shovels play on some of the AI boom in certain positions. You have reasonably valuations much lower than the Russell, for instance, much lower than the S&P. And we're starting to see M&A come back, acquisition activity. We do expect the IPO market to come back. So when we look at the fundamental setup and the valuation setup, you know, we articulate middle market private equity as the definition of growth at a reasonable price. You're getting growth, but you're not paying out the nose for it like you are in public equities. We're really excited about that. And then the private credit side, you know, it's really interesting because we've been in this higher for longer, stronger for longer environment. And even though the Fed is cut by 1% so far, we're still going to have higher base rates really as far as I can see. And because the economy stayed relatively robust, default rates should stay really, really benign. So, you know, investors in private credit should enjoy higher for longer in terms of income without a hangover of defaults, which is always the risk that you run whether you're investing in public or private credit.
Part of the reason why Apollo Global Management was up by something like 77% through last year. Troy, good to hear from you, sir. It's good to see you. Troy Gayeski there of FS Investments. Thank you. Looking ahead to 2025.
Yeah, a real kind of question about how we deal with the mess that he sees in the Treasury market. We've heard this for so long, right? That how are people going to buy all of these treasuries? It's the reason why some people focus on auctions very closely. And we hear Earl Davis talking about how there is no alternative for people internationally and domestically. So it really is setting up an interesting tension as we head into the new year.
10-year notes on the 8th, just looking at the calendar.
Thank you.
The 9th for 30-year bonds. All right. I'm looking at the same calendar.
Who's this? Who's this? You're
no, I'm here to support you. We're a team. Aren't we? What are you laughing for?
Yeah, no, I agree with you. It's just that, you know, please take the helm with respect to bond auctions.
I'm always looking at the calendar, Bramo. Doing it just for you. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. At least 15 people were killed in a deadly attack in New Orleans' French Quarter very early on New Year's Day. The FBI is investigating the attack. which involved a pickup truck and improvised explosive devices. The FBI is also looking into possible connections to terrorist groups and whether the suspect acted alone. The suspect, a U.S. Army veteran, was killed at the scene. And in Las Vegas, a Tesla Cybertruck exploded outside the Trump Hotel. Elon Musk says the explosion was probably an act of terrorism. The driver was killed and 7 people suffered minor injuries. In a series of posts on X, Musk said the explosion was caused by fireworks or a bomb. President Biden says officials are investigating whether there's a connection to the attack in New Orleans. Elsewhere, New Jersey asked a federal judge to block New York from moving forward with its congestion plan. The move comes after a federal judge largely rejected New Jersey's challenge. The congestion pricing program would charge $9 for drivers entering Manhattan's Central Business District during peak hours, starting this weekend. The plan was designed to reduce traffic and pollution while raising money for the city's subways, buses, and commuter rails. And that's your brief. John.
Hey, Danny, thanks for this morning. Thank you. One of those occasions where you needed the Bramo cam as Danny was going through that last story. Want to share any thoughts?
I'm going to get into trouble, but I'll share them anyway. That basically, New Jersey's going to sue to stop New York's congestion pricing to raise money for New York. That New Jersey benefits from being in New York, but they don't want their residents to have to pay more, and so that they have lower taxes. I'm just saying.
Okay.
I just think that.
Have you reached out to Governor Murphy personally? Have this
Governor
conversation?
Murphy, I just think you need to let it go.
Okay. All right. This will be fun. We should get him on the show. Do a round table with Hochul.
Let's try.
Yeah, sure. Up next on the programme, setting you up for the week ahead, we'll get you some movers going into the opening bell. The opening bell about 38 minutes away. Equities bouncing back from 4 days of losses on the S&P, higher by 0.75% with some morning movers. Here's Manus Cranny. Hey, Manus.
Jonathan, good morning. We'll kick it off with US Steel, rallied by 9.5% as we went into the new year. Nippon Steel put one last offer across the table. You, the government, can decide what production cuts we do in the next 10 years. Stock is bid. It's still trading below the original offer price of double nickel, $55. Roll along, Tesla. Deliveries are the numbers that we focus on today. The magic number, over 500,000. That will tip us into a record for the fourth quarter. But you've had down Ives. 10 to 15% of their stock price is on deliveries. 80% is on AI. And talking about vicarious trades, Bitcoin rallies, Microsoft goes in its wake. Jonathan.
Manus Cranny, appreciate it, sir. Thank you very much. As we count you down to the opening bell, a few things to watch. Going into the start of the new year, we get some economic data tomorrow. You're going to get ISM manufacturing, a PMI a little bit later on this morning. Then, of course, the big one is next Friday, for Payrolls Friday. Tomorrow, the lineup to close out the week, a nice shortened week for you, just to ease in, will include Priya Misra of JP Morgan.